All right, so we're here now. So once again, good evening, everybody. We are back once again to start where we stopped yesterday. It was quite unfortunate we couldn't be able to do something yesterday as we planned in the morning. We couldn't do anything in the morning because I have to leave where I went on time to be able to get here before 6 p.m. It's almost a 5 to 6 hours drive. So we're back to chapter 9, where we are talking about annuity. So far, any question from what we did to where we stopped? Any question from anybody? Anything that is confusing, so we can discuss it right away before we jump into the section today. Any question? Any question from anybody? All right, so it's assumed that everybody's on board. I think we stopped at, we have done deferred annuity, did we? I said everybody should be able to understand the 5 classifications. I think that is the basis of what we're doing. If you are going through annuity, you must be able to understand the 5 classifications. Those are classifications are what we're trying to expand to make it more meaningful. So, but if you don't understand the foundation, it's damn difficult to understand the expansion. Just like somebody's building a home, it is not
the foundation.
You do not build the foundation, you jump in to begin to build up. It's become difficult. So the 5 classifications, honestly, is what we're trying to expand. If you look at this 5.1, where we say fixed annuity, if you go to that 5 classification, we'll show you what fixed annuity is. So based on that, you'll be able to understand whatever we're going to do and whatever we say onward. If not, it's difficult. If not, you mess it up from beginning. And believe it or not, this chapter is so broad and somehow is confusing. That is just the truth. But no, the way to know it is start from basics and begin to know those terms one after the other. So let's look at classification according to the source of income. A classification as according to the source of income. I think that's where we stopped yesterday. So, am I sure? We stop here, I hope. Anybody? Any objection?
We stopped. That is where we stopped.
I think classification according to source of income.
Yes.
All right. So, of course, source of income, what annuity means by source of income, it could be where did the income come from? Or when the income is coming in, what source? So there's a lot of things involved in it. So we're going to go through it now to find exactly what I mean by classification according to source of income. But if we go from our initial classification, you would have known by now what classification according to source of income was. So when we are trying to expand it, it will not be as if you have not heard it before. It will be a continuation of what you have known before. So some annuities are classified by their investment configuration, the source of provided income payment. The investment configuration affects the income benefit paid. For this type of classification, there are 2 types of annuity, fixed and variable annuity. So the income coming from you to the annuity account, from where did they come? Where did you get the money? Invest in annuity. Where? So that is one of the things you have to know. Was it a cash that you have that you already paid tax on it? Was it a rollover? Was it a borrowed money? How did the income come? So for this source of income, we're going to have 2 types of annuity concerned on the fixed and variable. So a fixed annuity pays a guaranteed, predetermined level benefit payment amount during the annuity phase. Guaranteed. I always like to see this word guaranteed in annuity. Even in life insurance, whenever I see the word guaranteed, I'm just like, oh, I'm sure that thing is there. But in life insurance, we are told not to use the word guaranteed when you are making a statement or representation. So instead of saying it's guaranteed, you call it a representation. The application you fill in life insurance is a representation. So it is not a guarantee. Any reason, anybody who knows why it should not be called a guaranteed instead of call it representation? Who knows the reason?
Because you're not 100% sure that all the information were accurate.
Of course. So, of course, yes. But however, the information provided was to the best of your knowledge.
Mm-hmm.
So since it was to the best of your knowledge, you cannot actually 100% guarantee it. Of course, somebody can write his name on the processor. You missed one word, one of the letters. It's possible you can miss one of the letters in your name. Of course, you can miss the letters in writing the spellings of the month you are born. That is correct. So those are mistakes. So if you now say that your application's content is what? Guaranteed. It means that misspelling you did is guaranteed to be true. And some other person who is going through your application will see that, look, what is this person talking about? This is not the spelling of June. The spelling of June is not correct. And this man said it's guaranteed. What does the implication mean? That you have lied. So, however, you should use the word is a representation to the best of your knowledge. So the premiums are invested in fixed rates products, e.g. CD bonds, etc., to provide a fixed return based on interest rate guarantees. Of course, there is always interest rates in annuity. That is one good thing about it. There is always that. Because you put your money in a portfolio, why you will not lose, you will not participate in the loss, you only participate in the gain. So there's tendency and very high guarantee that what? There must be interest. So in annuity, when you are in the phase you are taking in what you put in, you take in the principal plus the interest. Then are you going to pay interest, a tax on the interest? Of course. Yeah. Are you paying in tax on the principal? No, depending on where the money comes from. Did the money come from the source you have already paid interest on, paid tax on it? Or did the money come from a rollover where you have not paid tax on it? So these are the things you're supposed to know when you are educating your clients on what to do about annuity. What is the source of income? Did it come from where you have already paid? Was it the money you withdraw from your bank? Was it a rollover from your past job? So these are the things you have to know. You have to have it in mind. That will guide you when the payout phase or the amortization phase begins, so that the person will not feel as if his money or her money wasn't complete. If it is the money from your bank, which means you have already paid tax on them, during the amortization phase, the payout phase, definitely you're going to get the principal plus the interest. However, that interest should be taxed. If this is the money you have not paid tax on, probably from your 401k, you have not paid tax on them, what happened? Both the principal will be taxed and the interest will be taxed because you have not paid tax on them, on the principal. So these are the things you have to get to guide you to know what to do and how to educate your client about the payout phase. So however, in the contract of annuity, there's always what we call the minimum interest rate guarantee, and maybe I may pay higher rates based on current economic market conditions. So it's one of the classification where we say where the investment based on, was it based the interest based on market trend. So these are the things we all of us should know. That's why I say everybody pay special attention on the 5 classifications. It's very, 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 very important. If it's confusing, go back there and review it so that you will know it. If you know it honestly, if you understand those classifications, you are completely done with annuity. And if it comes in the exam, you're gonna pass it. So for a variable annuity, premiums are what? Placed into a separate account. These funds are what? Invested in securities such as equities, that is common stock or preferred stock or debt security. Let me tell you, whenever you have a variable account, when you get this license, you are not qualified to sell a variable product. I hope everybody knows that.
Oh, I didn't know that.
All right. So as a life insurance agent, you are not qualified to sell a variable product except you have a security license.
Wow.
And what are the variable products? Bond, mutual fund, stocks. Those are the
Security.
And security. Those are the what? The 4 basic variable products which you are not supposed to sell except you have a life insurance license and security license.
What do you call those?
Variable.
Okay.
They are variable products.
It's bond.
Bond, you cannot say bond.
Stock.
Mutual fund,
Mhm.
and security. You cannot sell them. You don't have the license to sell them. However, can you go out and get license to sell them? Of course. When you get your life insurance, if you really want to go inside into financial industry, the best thing you can do to yourself is to get life insurance license and equally get security license. If you get them, you are made. There's no two about that. It's a career that can give you and can feed you. Imagine some people coming into your office to buy bonds. Imagine people coming to you to buy stocks of companies. You know what it means? You are mad. So the security license is, I think, about 6 series or 5 series. I can't really get hold of it. So those series have to pass stage 1, 2, 3, 4, 5, 6. But some people do it, particularly the young folks. When you attend one of the insurance company conferences that insurance companies organize, that's where you'll be able to see people who are making living through variable products. All right.
Hello, sir. Hello,
Any
sir.
question? Any question?
Yes, sir. And this SP, is it SP 500? Where does it come into play?
SP 500 product, SP 500 is, we're still gonna meet it, is about the market trend.
Okay.
When you remember when if you have had a policy, when you're trying to distribute the market, you want to know what type of market are you distributing it to? Where do you expect to give you more money than some of them are those classifications, some will give you more than others. So we're still gonna go through it on
Okay, sir.
some of the
Thank you.
chapters. Yeah. All right. So the fixed annuity. A fixed annuity guarantees what? A predetermined income. Predetermined. You see? See this word? Predetermined income. The income already known. So why would somebody not invest on where you have already known your income than where you are gazing to, you don't know whether you have income or not? So a fixed annuity guarantees a predetermined income or level benefit payment amount, which is paid each month for the annuity life. I want you to understand something. Anytime you see level benefit, level premium, what it's telling you is that they are equal. If what you pay today is what you're going to pay tomorrow. For instance, in term life insurance, fixed permanent life insurance, you are paying a premium. They told you that the premium is level. It means that premium is fixed. that premium is the same. It does not change. A flexible premium means that you can pay 100 today, tomorrow you pay 100. You can pay this month and pay next 6 months and pay after annually. So that is flexible. But level is this. What you are paying in March is what you are paying in June, is what you are paying in July. So just get it in your mind that anytime you see level, it means that it's fixed. The premium is fixed. Most times we see it on when we are classifying life insurance and the types of policies. We're going to see, I think, on chapter 4. So what do we do here? I think we're going to begin to speed up a little bit because we are wasting a lot of time on this. Variable annuity. Remember, we said you cannot say a variable product. But however, variable annuity, is it a variable product?
No.
All right. So, which means you can say annuity, variable. Remember, variable now becomes a type that's inside annuity. A variable annuity is a contract issued by an insurer. Insurer is the insurance company that allows the contract owner to invest premium in various investment options, unlike a fixed annuity. It includes two types: investment account, a general account, and a separate account. That occurs in variable annuity. So general account provides a guaranteed return. Separate account invests in equity product with no guaranteed return, but a higher potential for gain. There's one thing I want everybody to know. In annuity, you bear the investor or the insured bears the risk. Then in life insurance, the insurance company bears the risk.
In annuity?
In annuity, the insured bears the risk. Then in life insurance, the insurance company bears the risk. You know why the insured bears the risk in annuity? You know, for instance, let me even say it this way. When you bear the risk, do you think you will pay more or less than when you're not bearing the risk? If you have an investment today, they say this investment, all the risk is on your head. And you have another investment, they say the other investment is on my head. It doesn't concern you, but you invest your money. It doesn't concern you. I'm talking about investment. Remember, life insurance is never an investment. Please have that in your mind. So if you have, we're not out from life insurance, we're not talking about anything, any investments at all. We are investing. Myself and Sei is investing. We have 500,000 to invest. Now, we invest a product, we invest 500,000 in a product, and Sei invests his own product on me. Say I am bearing the risk. And in the other case, which means Sei is not bearing any risk. Now, me investing and I am bearing my own risk. Which one do you think that the performance and the payment will be more? When you are bearing the risk or when you're not bearing the risk?
When you're not bearing the risk.
When you're not bearing the risk, will it be more or less?
It's more.
Of course. So that's what I want to hear. When you're not bearing the risk, it's more. But when you're bearing the risk, means that it may not be more because whatever happens is on your head. So, but when you are the owner, you have the thing on your head, it means that whatever comes out is your own. But when another person is bearing the risk, you just come and go, inspect and go. It doesn't really, there's nothing altogether. So you are right, it's more. So let's see what happened in a separate account. A separate account.
Sorry, sir. What did you say about general account and separate account?
All right. We are talking about variable annuity. We said in a variable annuity, the insurer allows the contract owner. Who is the contract owner? You or me? Who put our money in our annuity? Who is the insurance company? The insurer is the insurance company. So in a variable annuity, the insurer, which is the insurance company, allows you or me, who is the contract owner, to invest our money in various investment options. One, they allow us to invest it into account. One of the accounts is called the general account, and the next account is called the separate account. Did you get it up to that point?
Yes, yes,
All
yes.
right. So we're now going to see what happened in separate account and what happened in the general account. Is it clear up to that point?
Yes, yes.
All right. So separate accounts invest in equity product with no guarantee return, but a higher potential for gain. When you invest in a separate account, you have what? No guarantee return, but higher potential for gain. You don't have any guarantee that you have a return. But however, if there is any return, you have a potential, you have to gain a lot. So which is the opposite of what? Opposite of what you have in general account. A general account will provide a guaranteed return. But what a separate account does not guarantee you a return. But however, if there's any return, it will be higher. So you who is bearing the risk, you decide to bear it. If there's at all any return in that the risk you're bearing, it will be far better than you leaving your risk for that person to bear for you. Is that clear after that point?
Yes.
All right. So in a separate account, it says is unique to variable. Separate account and general account is unique to what? Variable annuity. Remember,
So in general, what happened?
That's what
Your
we're
account has guaranteed return.
In general account, we have what? A guaranteed return. There must be something. But in a separate account, you are not guaranteed of any return. But however, if there's any return, there is potential for much gain to happen. But the general account, they guarantee you return. But when you shift the account, when you shift it to a separate account, you are not guaranteed of any return. But if there's any return, you have much gain to make. So it's just like people taking risk. That whatever happens, you know that if that risk is right, then you will make much gain. If that risk is not right, you will lose totally. So some people close their mind to do it,
Yeah.
do the separate account and see what happens. You are not guaranteed that will return, but you are guaranteed that if there's a return, then you will make a potential gain.
Thank you.
I'll be charged the whole night.
Okay, thank you.
Just
So
call
that
me
is-
60490.
Okay, if I want to go on break, I will call you so that somebody around 9 o'clock.
Or
So that's what it is. Now, a separate account is unique to variable annuities. It holds all variable investment options and allows the contract holder to do what? To control their investment, assuming the investment risk. So this is exactly what we are saying. When you do when you have a separate account, you bear the investment risk. You have no guarantee for a return, but however, there should be a gain if there is any return. But if it's a general account, you are automatically guaranteed for a return. Is that clear?
Yes.
In a separate account, you have the risk. Just like I use me and say to give example. Then in a separate account, you are sure that you are not guaranteed for any return. But however, if there's any return, you will gain much. In general account, you are already guaranteed there is a return. In that case, in a separate account, you are assuming the risk. While in a general account, the insurance company is assuming the risk.
So there's no point putting your money in separate account then.
No, why not? Why not? Why not? It becomes when you teach your clients or your customer the two differences. It's left to that person to make a choice. But if left to me as a person, if let's assume you are my agent, you are writing my annuity, variable annuity product. You are not writing it for me, and you explain this to me, finish. What I would say, oh, so if in a separate account, I'm not guaranteed of any return, but if at all anything happen, I'm gonna get more. Then this other one, you are already guaranteed there'll be a return. So what will guide me will be that potential for higher gain. That is what will guide me in making decision.
If you are going potential for higher gain, that means you are going for separate accounts.
That's what I'm saying. Say somebody said that, so there is no need for separate account. That's what I'm trying to classify.
Yeah, that's what I said it too.
All right.
Or you can diversify.
So
okay,
I'm using,
you can diversify. Okay.
I'm using myself now as an example. That if you are my agent today, you talk to me about investing on variable annuity products. Now you told me that, look, we have two accounts, the general account and the separate account. That the separate account, I bear the risk. The general account, the insurance company bears the risk. So what do I do? And you go further to tell me that I should know that in the general account, I'm guaranteed of return. But however, in separate accounts, I'm guaranteed that there is no return will come. But if return comes, that it will be much gain. Remember, investment is a risk, and the risk is what? Gain. There is no market you will not take a risk. You don't take a risk after all.
Yeah.
Succeed. So based on that knowledge, I'm talking about me. I will now decide, say, look, the first question I will ask you, I'm my agent, am I going to lose my money in terms of the principal? That is the first question I will ask. I say, am I going to lose my principal if I lost, if there is no guarantee for return? Am I going to lose my principal? And you went ahead to say no, but the gain is what we're talking about. I said, of course, go ahead. I mean, in me, that would be my decision. Since my principal will be there, we are not talking about gains. I would say, go ahead. I will take a separate account. I mean, me in person. Some people their risk-bearing level is lower. They don't want to take risk. Some people, they want to take that risk and see what will be the outcome. But the major thing that will guide me as a person will be my principle. Is my principle going to be vanished? That's what I'll be asking you. If you assure me that my principle will be there, it's a risk. I'm going to take it. For me, in person. But for you, you don't like taking risk. Of course, there's some questions they will ask you most often. Say, do you like taking risk? You say no. Yes. Some people will say yes, they like to take risk. So when you like to take risk, this kind of thing is what can make you to take a risk by all means, You want to take a risk, take a risk. Yeah. So some people will do it, some people will not do it. So let's look at insolvency. I hope everybody understood it up to that point. Yes, sir. Then insolvency protection. Remember, who can remember when we treated in life insurance, what are the 4 companies? What they do is to make sure that insurance company their insolvencies are protected.
Oh.
Yes, 4 companies. Who can,
Ambest.
Yes.
Moody's and Paul. Fetch, and there's one again.
Oh, I haven't come then. I don't even know what this is all about.
I remember 3.
All right. So the person that says doesn't know what it's all about. Remember, in banking industry, there's always a body that ensures that banks are well fitted in terms of their financial surveillance, that they are strong enough to be able to hold people's money. Then if anything happens, that those companies can be able to pay people back their money. In the banks, it's always there. So in life insurance, we have these 4 bodies. Their duty is what? To make sure that insurance companies keep a strong surveillance. When we talk about surveillance means that you are lacking financial foundation. You are lacking standing. Your money, the insurance company is shaking. Or if you're in a bank, means that the bank is shaking. There's financial strong base is not strong at all. It's shaking. So in an insurance company, we have through these 4 companies, what they do is to make sure that all the insurance companies their financial foundation are very strong and ready to accept any business.
So who are they?
One
Yeah,
of them is
yes.
Moody, they're on Fetch.
Yes.
Standard
I can't hear, I'm sorry.
All right, Chinonye, can you take from where you copied, can you just read that for her to write?
Okay, what I said is Best, AM, then you give it a space, BEST, best. Then another one is Standard and Poor, pause. POR, then apostrophe of S. Then the third one is Moody, like a mood, MOODY, apostrophe of S. Then Fetch, FITCH.
FIT.
We may still see it in chapter 4. I think
FITCH, fetch.
We're still gonna see it in chapter. I hope.
Yes, madam.
Sorry, can you put it on our WhatsApp group for us?
Okay.
All right,
Thank you.
Yeah, put it there. Yeah, that'll be fine. Either we meet it in chapter 2 or 3. I can't really remember. But I think there's one other chapter that we're still gonna see it. It's very, very important for everyone to know it. So flexibility and risk. So we are talking about insolvency protection. If the insurance company becomes insolvent, means that the insurance company financial base is shaking, is not strong. Creditors cannot claim assets in the separate account, but they can claim assets in the general account. Do you see one of the risk? If the financial base of that insurance company is not strong, creditors, which means those who are invested in separate account, cannot claim assets in the separate account. That in the people who invest in the general account, we have to claim assets. So if you are the investor, what will you do in that aspect?
That's why I will have to go to general. I wouldn't even.
You don't want to bear risk. But for us, people like us who want to bear the risk, the first thing we will do, we want to find out what is the solvency of that insurance company.
That's true.
Are they strong or are they not strong? If they are strong, why not? And if not, I will go for it. I will invest on separate. I will invest on separate. You cannot be rich in life. You cannot be a big business person without
risk. Yes.
There is no way. You must have to take risk. But what you ask yourself, is this risk worth taking? And more especially, what is going to happen to your principal? That's a risk taker. That is always the question that will come to your mind. Of all these stories, if I invest 2 million today and maybe I didn't get anything, what happened to my 2 million? Did it go with the investment or did I get it back? If they assure you that, look, you get your 2 million back, you close your eye and do the investment and let it happen. It's a risk. If you stay 2 years, 10 years there, you didn't get anything, at least you get your money back. After all, if you put that 2 million in the bank for 10 years, how much will it yield for you?
Engineer, I don't agree with you. How can you put money after years? You don't yield anything. Will you be happy? The sense of putting it there is enough for you to make profits.
It's an investment. You decide to go for it. If you decide you are going to put a separate, maybe 2 million in a separate account, if eventually you make profit, it will be triple or quadruple what you have made in a general account. It's a risk. It's a risk taking. Yeah, it's risk. Two of us will decide. You decide you are going on general. Me, I say I'm going on what? A separate account. You put our money. I ask you, I hope my principal will be there. I say, yes, of course. Then your own concern is your principal and what you're going to make. Me, as a risk taker, what I'm going to make is secondary to me. My primary concern will be my principal.
Okay.
So that will be my primary concern. So it's only for risk takers who will go for it. Then I use the example, sir. After all, if you put 2 million in an account for 10 years, and that money is still there, the principal did not go, did not make anything to you. What will you? Is going to be too painful to you? After all, if you put in 2 million in banks, it's 10 years. How much are you gonna get there? How much? Be sincere. How much are you gonna get? With their 0.00101%, how much is gonna make? May not be up to 10,000. May not be up to 20,000 or 30,000. And if you put it in a separate, let's assume you put that 2 million in a separate account with all those shaking that you don't know, you're not sure, not guaranteed. If you finally guarantee it, you're looking at making up 500,000. So why would you do that? That's why the rich keep getting rich and the poor keep getting poor. A rich man, people do what they call betting. People bring up millions to say they put this in. If this doesn't happen, I lose. If it don't happen, I take. No, that kind of thing. People put their money on it. It's risk takers. Risk takers. And if eventually they win the bets, they get a lot out of it. If they lose, that one self, their own is worse because the principal will go. All right. So it's just a mindset, everybody's mindset. What do you want? Some people are born to be risk takers. Some people are born don't know how to take risk at all. But I come to know that in business, there's always risk involved. And if you can't be able to bear risk, if you're just that person that doesn't bear risk, then there's no need of going into business. Any type of business, there's always little or more risk involved. Yep. So, but they can claim assets in the general account. Separate accounts are generally registered with the Security and Exchange Commission under Investment Company Act of 1940. So the separate account we're talking about is quite different from the general account. The separate accounts registered with Security and Exchange Commission, which is SEC. Now, let's look at flexibility and risk. Variable annuity offer flexibility, allowing, when you say something is flexible, it means that that thing is not rigid, is not as it continues to change. So, because variable annuity offers flexibility, it allows contract owners to determine their risk level. So, just like what we are talking about, general account and separate account, this is one of the things that variable annuity offers. It offers variability, allows you who is the contract owner, to determine their level of risk. Just like Chinonye said, you can't take that risk. Me, I say I'll take that risk. Variable annuity give us the opportunity to determine our own risk level. Remember, if you want to be rich, you take higher risk. If that risk, if it does not materialize, you lose. But if it materializes, you are on top there. So that is how it is. I use the word, I said that's why the richer keep getting richer and the poor keep getting poor. The poor man will hold his 500,000, hold it like he's holding somebody's life. Have you seen some people? All right, when you start this business, there's something you're gonna understand. Some people, for them to tell you their social security, oh my God,
Yes.
is as if they are buying first class. No, no, that one is small. First class is small. In fact, if you ask them that, they hold it as if that is totally their life.
Yes, it is. It is.
It is not. It is not.
Believe me, in this country, if anybody messes with your social security, you are done.
How? Tell me.
Yeah. You know, the social security here is everything. If anybody is looking for whether you committed a crime, that's the first place they go. What is your
But have you forgotten that that is the database where they use it to check everything they want to check. That so you're an agent, you are talking to, somebody's an agent trying to help you out to refocus your finance level. When the person is all right, can I have your social security? It's one of checking who you are and what you are and actually making sure you are on a good foundation. Then if the person asks you that question to you, you feel as if that person is asking you to give him or her their life. I don't think it's a mindset. Let me tell you, it's a mindset.
Let me tell you, also, you might think because you have a clean record, you don't know how people who have something to hide feel about giving their social security.
Is it, all right, there's one other thing I wanted to know. There's something I want to know. Most often, you cannot commit crime you don't commit. We do not commit. Yes, you cannot commit crime that you did not commit. Somebody take your information to go do whatever you want. You don't know anything. If eventually they caught up with the person or they caught you say you did it, may looking at you, interviewing you, you may not even know what they're talking about. You may not know what they're talking about.
I think there will be no need of us arguing about this.
However, in business time, what I'm trying to let everybody know is that what you're going to see when you begin to the business. At the point, you're going to ask people some personal information. Of course, we are trained because of HIPAA, we are trained to keep people's personal information as secret as whatever. And you are allowed to keep people's personal information for at least 5 years before you can do anything with it. In terms of doing anything with it, either you shred it or you do, either you shred it. You may not burn, but you shred it. You cannot trash people's information anyhow. That one's another issue. But what I'm trying to say, in the mindset of our community, most often it's difficult for them to release information that can help them. That's what I'm trying to say. You're going to witness it when you, after finally you pass the exam, you're going to witness it. But a person like me, if somebody asks me such question like, what is my social security? One, I want to know in what platform you ask me that question. Why? If I have come to you to educate me on something like maybe life insurance policies, you're going to educate me before I write a policy. And after the education, I found out that, look, this is something I need in life. This is something I need in life. Now, you reach a point to say, all right, can I get your information so that I can be able to check? I'll be able to start the process. Now, for you to bring out social security becomes a big problem. That's what I'm trying to say. It's just a mindset that those who are criminally minded will not even ask it from you. They will get it from however they want to get it. That is a fact.
But do you know that there has been people who will come to, because people don't just start acting like that. There are people in this country who, what they do is come pretending to be helping you in one way or the other. And then the next thing you see is they take that your information and go and start doing something funny.
Anyway, that may be right, but the truth of the matter is that when you are clean in your mind, that you don't even know what is called or what such a thing is, you are as innocent as every other thing. You are there to help people, teach people, educate people on what they need to know. Then the issue of their own information is very, very secondary. It's not something that is pertinent to you. You know, definitely you just get that information, do what you want to do, and give them the information back. Our community finds it difficult, and I'm telling the truth, it's based on our background.
Yes.
When somebody is evilly minded, it becomes difficult to get evil out of evil. No, that's the truth. But people who have a broad mind, who knows that looking at you and their questions and what you intend to do, of course, you have to reach a point before you ask person about his personal information. You must reach a certain point. So if you would allow that person to be talking to you until the point that those personal information are needed, then I don't think it becomes a big deal. But however, your concern will be, please, I'm reducing this for you. Keep my personal information as secret as whatever. It becomes a communication between two people. However, as an agent, remember, you are under HIPAA, which means you must keep people's personal information secret. You must not keep it beyond, you must keep it where you can see it. You must lock it or be under lock. You're not gonna do anything with people's information. You have to keep it as secret as whatever. It's there in some of the chapters we're going to meet. You know how to keep people's information. You ask for people's information. Yes, we're gonna touch them, but however, you must have to know how to keep people's information. Is in one of the chapters we'll meet. All right. So purpose and performance. All right. Qualification and regulation. To say a variable annuity, FINRA, a FINRA Series 6 or Series 7 security registration and a life insurance license are required. So remember, I told you that you cannot sell variable products except you have security license. The security license in Series 6 or Series 7 is stage 1, stage 2, stage 3, stage 6. So you get to get them. People have gotten them. A lot of people who got them today, they have a very big office where people are coming to them to seek for how to buy stock, how to buy bond, how to buy mutual funds. So those kind of people they're on another level of life insurance. They're another level of being an agent, you know. They make their living through that. So some people can decide, say, look at the area I want to go deep. Some people want to do something and make sure they do it completely, not half. If you enter life insurance and you get only the life insurance license, you are just doing it half. You want to do it, going into finance, go straight and get your financial security license so that you can be formally presentable to say this man is financial guru. When you start to talk to people, they will now understand what you mean. So purpose and performance. Variable annuity were created to provide better protection against inflation than fixed annuities. They offer control over how contributions are invested as characterized by variable rate of return. During the accumulation, contribution minus expenses are used to purchase accumulation units. All right, so I think if we do like this, we're not gonna stop here. So variable annuities sub-account, we're not gonna look at that. Equity index annuity. All right, remember, I want you to know, whenever you hear index annuity, it's like it involves with market trend. Somebody asks for SP 500. You see, look at this. For that person who asked that question, we're still gonna see it as we go from. But I want that person to watch clearly what I'm going to do now. We are talking about equity index annuity. Is a fixed, non-variable annuity that offers a rate of return linked to, but the funds are not directly invested in. It's linked to what? Stock market rated index. Stock market rated index. Equity index account is also in life insurance. Index account in life insurance is related to what? Stock market related index. Remember, if 401k is linked to stock market rated index. It's controlled by Standard & Poor 500 index. There are a lot of them. Global index. So those are what regulates the stock. When you say you're losing, it means they are going down. When you say you're getting, it means they are going up. However, what separates you from losing is because you indexed it. As it's compounding, you index it. When you index it, what it means that your losses are not your problem. What your gain is where your mind is. You're always gaining, but you may not lose. Which means at a particular point, if it's losing, your own is locked up.
Say that again, I'm sorry.
All right. So when you hear the word index, it means that what is being controlled by the stock market related index, such as Standard & Poor 500 index. Somebody asked me before, what is SP 500? So when you hear index, even in life insurance, It means that you as a person or your investment, whatever, will participate in gain and not in loss. If there is a loss, you are not bothered about it because where you are is indexed, is locked up. So it's only open up for you to continue to gain and not to lose. If it's going below, it's not your issue. It's going up, yes, you open up your umbrella to collect more. So how do did you get it?
Yeah.
All right, so that's what index is. Index life insurance. You can hear it when we go to, I think, types of life insurance, we're going to see it. So index. So for at least now, everyone know what it is, index. Most people, when they want to write policy, they're going for index. Because nobody want to hear loss. Everybody want to hear gain, you know? So for you to be, for your attention to be only in gain, that account must be indexed. So look at this, index annuity provide the contract owner with a safety of principle. You see what I said before? I will be concerned about my principal. Is my principal, if anything happens, am I going to get my principal back? You tell me yes, then
Principal is guaranteed.
I will invest anything I want. I don't, as far as my principal is there, then highest I lose on I don't get any interest, but at least I still get my money back. That's for those of us who can bear risk. For people who cannot bear risk, they don't want to hear that. They want to make gain, even if a little bit. But we will get big eye. We want to get more. So as far as the main key, which is our principle, is there, is guaranteed for us. So the index annuity provides the contract owner with the safety of principle. What means your principle is guaranteed. And a guaranteed minimum return, e.g. 0%, since higher percentage of the contract owner premium is invested in high-grade government bonds. See it? So this provides a downside guarantee if the market performs poorly. In other words, this type of contract allows the owner to participate in market gains without assuming the risk of market decline. Did you see what index can do for you? When any of your account is the index, it allows you to participate in market gains without you assuming the risk of the market decline. If the market is declining, it's not your problem. You are only gaining. Gaining, that is index. So at least everybody hear it up to that. In any account you participate in the gain, you don't participate in the loss. You have to hold strong such account. Yes. In annuity, you do not lose. You participate in the gain. In index, universal life insurance, you do not lose. You participate in the gain. So any account that is indexed, hold strong to it. Always go for it. Because you will gain a lot, but you will not lose. However, the most important is that your principle is what?
Safe.
Safe. Is guaranteed that your principle is there. I think that's the most important thing. All right. So please, at least if you want to be a businessman, sometimes you get to open to assume a little bit of risk. Assume a little bit of risk. That will help. So market value adjusted annuity, MVA, also refers to modified guaranteed annuity. Modified guaranteed annuity. This one shifts some, but not all, of the investment risk from the insurer to the contract owner. Remember, in this index, you are the contract owner, you bear the risk. And what is that risk? Of course, your principal is guaranteed. The risk of not getting, or the risk of not getting having any interest is the risk you are bearing. It's not worth bearing. To me, I think that risk is worth bearing. Than the risk that your principal, you do not see, and the gain did not see. Which one do you think is better? Your principal, you may not see, and the gain, the so-called gain, you may not see. Than the one, at least your principal is there for you. You are now looking whether you gain or not. Whether anything happen or not, your principal is there for you. So which one do you think you will go for? So we have another type, market value adjusted annuity, another type. You say in this one.
Sorry, sir, what do you say about modified guaranteed annuity?
That's what we're trying to talk about now. Yeah.
Okay.
So the modified what is that? The modified account work with the market value adjusted annuity. What it means that part of the risk is shifted towards the contract owner. They move part of the risk from the insurance company to the contract owner. That is what modified guaranteed annuity. Modified annuity is what it means that part of the risk that the insurance company is holding for you, part of it is shifted to you, the contract owner. That's why it's called modified, because the risk level now is somehow part of them is shifted to you. So in such case, you can see that you can still be making money, but it may not be as regards to when it's the index, when all the risk is being handled by you. So that's what, remember when I used Say and myself to give an example, that's exactly what is going on with annuity. When it's modified, means that the risk that's being held by the insurance company is now, part of it is now moved to you, the contract owner, to you who have put in 40,000 to his annuity account. Part of the risk is shifted to you. That's modified guaranteed annuity. Any question on that? So why is they doing like that? Because most of the time, the annuity account value fluctuates with changes in market interest rates. Remember, we said all this is what involved in market trend, whether its market is up or whether market is down. So when part of the risk is shifted to you, the annuity account you have now will continue to fluctuate, and the changes in market interest rate will now determine what you make or what you lose. In other words, it is a type of single premium deferred annuity that allows contract owner to lock in a guaranteed interest rate over a specified maturity period of specifically 2 to 10 years. So remember, in annuity, you can put annuity for a particular year. You can say 10 years, you can say 5 years. Some go ahead to say 15 years. Some even say 20 years. You have locked in for that 20 years. If it's index, imagine what will happen there in the next 20 years. Even as the market continues to go up, definitely, one thing everybody should know is that as far as we are concerned in the world, what is going on, the market is going up. There's no two about that. Because what? The tax is going up. Everybody knows that the tax you pay today is not even the same. Will not be the same tax you're going to pay in the next 1 year.
That's
all right.
true.
Go back now to your school where you have your first maybe you have, for those of us who are educators here, go back to where you have your bachelor's. If you have your bachelor's in this country, check how much your tuition was then for a particular course program. Then go back there and ask them what's the tuition now for that particular course. We see the changes. Go back to the apartment where you live when you come to this country newly. How much were you paying? Go back there now and ask how much they are being paid. So, what of the car? Go back to the car you bought 5 years ago. Go and price the same car, see what it is today. So, what that is telling you now is this. Now, particularly this evening is the right time for you to invest. That's what it's telling you. Because the market rates will continue to go up. There's no two way it continue to go up. So invariably you fix your money somewhere with you taking part of the risk, which is the modified guaranteed annuity, definitely there will be growth in the next 10 years. So it becomes the opportunity comes that you can invest right now. This is the right time for you to do an investment, because what you invested today, by the next 5 years, maybe is going to generate more than whatever. It equally applies to
changes.
it applies to property investment too. The house you bought 100,000 today, the next 10 years, go and price that to the house, how much you're going to buy it in that particular location. So that's how it is. Because everything is going up. Everything is going up. Interest rate is moving up. So I remember our interest rates in our home then was 2.something%. I don't think anybody can get interest rate of 2.something% now. If you're buying a new home now, it can be 2.something%, 2.5%. It's difficult. The least you can get now is about 4%. So that is it. That is it. So this is the right time for you to do anything you want to do. Tomorrow is not sure. You're not sure what the market will be. But from look of things, the market is not going to be as favorable as it is today. So let's look at straight life annuity. Straight life.
Can you go back to that modify? I want to get something there, please.
Me too.
Modify guaranteed annuity. I want to get something.
That is the.
I want to make a small note. Yeah.
All right. The market value adjusted annuity. Market value adjusted annuity is also referred as modified guaranteed annuity. What does it mean? It means that the investment risk, part of the investment risk is shifted to the contract owner instead of the insurer.
I already made my notes. I'm done.
All right, you're done. All right. So, but also know that modified guaranteed annuity is also the same thing as market value adjusted annuity, MVA. So in case in the exam, you may see MVA, which is market value adjusted annuity, is the same thing as modified guaranteed annuity. All right. So let's go to straight life annuity. What does it mean and what does it tell us? And why must some of us who does not always want to bear risk, we like it, and why must some of us who will say whatever happened, as far as my principal is there, we always like to only go for it. So this is a contingent option, also refers as a pure life annuity or life annuity. Whenever you see straight life annuity, it's also called pure life annuity or life annuity. So you can see it has a three names. One, pure life annuity, can call it straight life annuity or life annuity, is classified according to the period during which the annuitant will receive income. Remember, when we are talking about receiving income, is just like we said, the annuity has two phases, the accumulation phase and the annuitization phase. The annuitization phase is when you begin to receive income. And one thing you should know is that the annuitization phase begins when accumulation phase ends.
Yes.
And again, we remember that when you have a lump sum payment in your annuity, meaning that that annuity has been fully funded, such annuity does not have accumulation phase because it is a one-time payment. So all this is what you have to know, put in your head, so that if any question comes, no matter how it comes, you can be able to know where they are going from and what they want to ask you. Annuity has two phases. One, accumulation phase. Two, and the second one is annuitization phase. The accumulation phase is when you are putting money in that account. Then the annuitization phase is when you begin to take money from that account. One good thing about the annuitization phase is that when you begin to pay out the money, you're going to get money, both the principal and the interest. Now, remember, in lump sum payments, single premium payments in annuity, you have fully funded the annuity.
In lump sum.
So, lump sum. So such annuity does not have accumulation phase. Is that clear to everybody?
Unlike
Yes.
deferred.
Unlike deferred. Deferred has accumulation phase because you said, I'm going to be putting social amount in this account for social period.
For
Social
future.
period is the accumulation phase. Then when you withdraw, when you want to take money out of it, which is the amortization phase, you're gonna say, I want to take my money from, I put this annuity today, which is January. Now I'm gonna take the annuity by 2035, maybe around 10 or 15 years. From 2035 now becomes the amortization phase. You will say, I want to take that money from 2035, by then I will be 65 years. I want to start taking it until when I get to 75 years. So that period you are taking the money from 2035 to 75 years, it becomes the amortization phase. So these are what you have to know. There is no accumulation phase in a single premium annuity. So if you begin to get all this parts, put them together, I'm telling you, you do well in annuity.
Yeah. Well, movement? No,
All right.
no. Just, okay. Just leave. Yeah. Okay.
So the questions in annuity will come by when you put all these pieces together. You know them, put the pieces together. You know, like we're talking about cell life annuity, you know what it means? You don't need to cram. Just on your own understanding, what does it mean? That's what you need to know. If you know it on your own understanding, what does it mean? Because this is exactly what we'll be teaching people, well, in terms of telling them what the type of annuity they want to buy. Because a lot of us out there, most importantly in our communities, a lot of us out there, they need to have annuity. Most of them have their 401k, particularly in the job they have quitted for the time source for a long time. The best thing for you to do is to roll it over to annuity, where at least their principal is guaranteed. Come on. We're not now talking about the gain. We're talking about the principle. If you have worked throughout your life and you make 250,000, that's the principle. You want to put it where that principle is guaranteed. I told you guys what happened to my own. I want to roll over. After seeing it, I do all the application. When I went back, $2,000. $2,000 was missing. Huh? What do you remember for me? If I don't have that knowledge, I will ask who collect who's steal my money. So that's what, you want to bear the risk. Let me tell you another thing. You want to bear the risk, you manage the fund by yourself. If you don't want to bear the risk, somebody will manage you, call them managers. And no one thing, you pay the managers, whether you're losing or you're getting, it's not their business. You must pay them. After all, if anybody who's working must get his salary. Is not the truth?
That's true.
Yeah. So, but you want to manage the money by yourself. You don't pay nobody. You ask yourself, those managers, what actually are they doing? Somebody was talking to me today about one particular investment. So he was talking to me. He said, there is people who can take care of the business. There's one language she used. She said, consultant. Say, they are consultants. Consultant. I said, what kind of consultant? I said, they are consultant. They will show you how to invest. I said, what do they consult? What are they going to show me? So sometimes there's a level we reach. You see, some of those things we sell, or some of those things we buy, we bought it out of ignorance. That's the basic truth. Some of the things you buy is knowledge you should have acquired. You're buying it out of, you're paying for your ignorance. You call yourself a consultant in a particular issue. They go to online and get those information and say to you, the same information, you are equally privileged to go online and get them. You pay them 10,000, 20,000, 100,000. Say they are consultant. They get those information. They do you abarakataba. Get the information and give you. The same information is online. One thing I like this country, I so much love this country is this. They don't discriminate in terms of information provision. What is available to A is available to B. And you have to seek information before you get it. Then somebody will go and get it. If you get that information, he will come and sell it to you. He'll tell you that he or she is a consultant. However, this is the same information that you are privileged to even get to.
But they know that most people are so busy running around that nobody has time to go and do that. That's why.
But who said that you don't have time for it?
Yes, a lot of people who doesn't have time.
To do what?
To go and look for those information.
All right, let's take for example. Let's take for example this thing that me and you are doing today. Is it a question of time or not? Somebody doesn't know that what he's supposed to do. It's not about time. It's about somebody not know what he or she is supposed to do. When I write 80,000 term insurance, if I had known that, look, there's something more than that, do you think I will do what I did? No, I will not. I will do it more pronounced, more secured, more interesting, more guaranteed. So I'm not going to go do something that is haphazardly. No. So it's just a question of our people does not show interest most of the things. Just like we said, most of us, and that is true, most of us today have not one day log into their 401k to know how it's working. It's true. Does it mean they don't have time? They have time, but they don't have
the knowledge. They don't even know what is going on.
Interest. They don't have the interest. Our people, some people working. What they're after is just to clock in, clock out. They don't even care how much they're making. They want to open their bank, log into their bank and see big money. So it's just our orientation, our mindset. And that's exactly what we're trying to change today, to change the mindset of everybody. We have time to do anything we want to do. Anything that would make you not to do what you want to do, that is the more reason why you should do it. Some people will say, oh, I have my children around, I have this. Let me tell you, the children itself is the reason why you should go out and do those things. Excuse me. Yeah, for I'm in the class. Yeah. I don't know. I'm in a class right now. We'll talk about that. Yeah. Bye. Yeah. So what I'm trying to say is that most of the thing, it's not about time. It's about interest. It's about you picking. Our people leave what they're supposed to pick into. They go and pick in something they're not supposed to pick into. Is our mind, is our general upbringing, and our interest is built towards some of the things being done for us. That's just the truth. You remember most of us who are immigrant, if they are to be where they are today, they may not even know how to drive. You know that?
Yes.
But this country, we teach you how to do some certain things for yourself. You coming here, whether you are afraid or not afraid, you must drive. Because if you don't drive, you're not going nowhere. So that mindset has come to everybody that if you're coming here, you must not have to drive. But where we come from is for the privileged. It's only the privileged that can do that. But here, this country is where everybody's accommodated, as far as you're doing the right thing. So that is the thing. All right. So let's go to, we're talking about Straight Life. It's the contingency option, also refers to pure life or life annuity, is classified according to people during which what the recipient will receive monthly payment for life with no refund to their family or any beneficiary. Straight Life. Are you going to do a Straight Life annuity where you, the contract owner, only you is meant to receive the benefits, the benefit? If anything happened, you don't have any beneficiary to get there. You only design in a way that is only you. If the person finally passes, there it ends. There's no beneficiary to collect whatever remained out of your investment.
Sir, does the money go into an estate?
It's not really, it's a contract you have signed. Definitely, insurance company will take it. It's not going to your estate. You decide to do it. However, such account will pay you more is only for you and only for you alone. You do not accommodate anybody. Whatever remains when you are during the period of amortization, they are paying you at a point the person passes. Whatever remains go to the insurance company because it's not going to your estate, neither to your beneficiary. What will go to your estate is that thing that requires your beneficiary to take, and you don't have any beneficiary, it will go to your estate. But however, for this one, there is no beneficiary, which means it's not talking about estate. Whatever remains, the insurance company becomes their gain, as far as the contract owner has died. So that's straight life annuity.
I have a question,
So,
sir. What will make someone want to pick this one? I'm just curious.
That's a very good question. But let me shock you. Do you know that some people put life insurance on their pets? Policies.
Mm-hmm.
Some people put policies on their pets. So the question would be, what makes somebody to put policy on their pets? Some people want, is it because, just like I'm talking about our own community now, we are wired that somebody must be there when you're not available. Some people are wired to know that it's only them but them alone.
Mm-hmm.
Yes, that's just the truth. Some people are wired to that if they're them, it's for them and for them alone. Yeah. See, that's a very good question. What would make somebody to go and pick that? But believe you me, people are taking it.
But to tell you the truth, it's just depending on exposure. I have had the privilege of consulting medically with people. You find out most people, especially people who are very rich, you will really, when you get close, you find out they have nobody other than themselves.
Yeah. Yes.
Mm-hmm. A lot of people are lonely.
Yeah, it's true.
Yeah.
Like my regional HR, he's the only he has no child. Now he said I went there to ask him some question in regards to this investing. So he said now he's eating his own life insurance because he doesn't have anybody to give it. Like
so, but see, let me tell you, I told you guys that I was talking to somebody about the guy had a daughter. At least he is making close to 120,000 annually. So I talked to him, said, look, boy, you just had a daughter newly, and this daughter can be $1 million baby. He said, what do I mean? I say, is there any way you can come to my Zoom? Let me talk to you further. He said, no, it's not that thing people are talking about. I said, what is that thing? He said, it's not about life insurance. Say, this is dollar. Say, not going to put anything for her. Say, his dad did not put anything for him. Say, when she grow, whatever she should take.
Mm-hmm. And he forgot that he grew up in another part of the world, and now here we are.
Mindset, honestly, mindset is a spirit that must be guided.
And it's life.
If you guide their mindset, which is the spirit in you, you do wonders. That is just the truth. You begin to unfold those things that was folded. Mm-hmm. So for somebody who decides to take a straight life annuity, he does not bother what happened. But for those who have a broad mindset, knows that even the church needs the proceeds. Even the community needs the proceeds. Even some helpless organizations need that money. So why not say, whatever remains to me, let's go to this organization. It's going to affect life. It will change some people. It will touch some people to become what they want, what they could not have been. So that's a mindset. It's a mindset. than to say, oh, I don't have any beneficiary. Of course, this kind of thing cannot go to your estate because, of course, there is no beneficiary attached to it. So whatever remains, go back to where it come from. So that's a mindset. For somebody to come up and just first say, ask a very good question. Say, why must somebody decide to choose this?
Yes.
My brother, me and you, we think otherwise, but some other people do not. They go ahead and get what they want, It's about them. It's about themselves.
Thanks for the explanation.
It's about themselves. It's about them. They don't care about you.
But this person that has already started eating his life insurance benefits, how did it work that he has already started eating his life insurance benefits?
All right. Let me tell you. Let me give you another way to explain that. Most of us here who are immigrants and some other people too, must have, when they come to this country, they must have worked as a caregiver somewhere. Is that true? When you are working as a caregiver, that place you're working as a caregiver, they are paying you. They pay the company now pay you. And they are paying that from their money, not from any other thing. Where do you think that money come from? It comes from a policy. How do you do that? You put a policy, you have accumulated enough cash, some people have accumulated millions of dollars of cash value. Now, you reach maybe around 65 years. These people is the people that have this policy we are fighting for our people to get. They got it when they are 2 years, 1 year, 3 years. $5 million policy on their head. When they get up to that 65, the cash value in there is now marvelous. What do? By 65 years, they can say, I want every month 10,000 to be paid to me. The insurance company will make it every month. It becomes an income. Every month, 10,000 be remitted to the account. So that's how they begin to eat their money. That's how they begin to eat their money. So that's exactly what it is. So you that have your policy, you may reach at a point, of course, you don't want to pay more. You don't want to stop payment. Say, all right, I want this money, my cash value, which I have accumulated, I want it to be paid to me monthly because then I can no longer work. I can no longer make another income. Remember when I said that some people can be rich when they retire. I said it one time.
Yes.
Yeah, some people becomes richer when they retire. Somebody asked me how. I said, all right, let's take, for instance, now that you're working, you're making $100,000 or you're making $120,000, which is average of $10,000 every month. Is that true? You're making $120,000 annually, which is average of $10,000 every month. Now, let me tell you how you can become richer even when you are no longer working. Remember, you have worked for that so long, about 30 years or 10 years, which means you are fully funded in Social Security. You can receive maximum amount of Social Security. And the kind of job that you're paying you $10,000 every month means that you are earning massively. Means that you are paying goods in your Social Security. When you retire, you are fully funded. You cannot get less than $3,000 every month. Now, let's just be fair. You are getting $2,000 from a Social Security. Now, let's go to your 401k. Probably you are smart enough. You roll over previously where you were working before. Your 401k, roll it over to annuity. Now you have come to this point. Your annuity has accumulated much interest, and you want to start to take in from the annuity. Remember, it's a retirement plan. Now you are getting $2,000 from your Security. You come to the annuity and say, oh, I can get, by what I've invested, I can get 5,000 or 4,000. Let's assume 5,000, 4,000 from my annuity. 4,000 plus 2,000, how much? 10,000 from two portfolio. Now, you come again, check. So, oh, I have this life insurance policy. My cash value is so massive there. I can get, after I'm 65. How long does it remain for me to die? This money is there. A lot of money is there, and I've made provisions for my children, my grandchildren. I made provision for them. I can be taking 7,000 or 5,000 from that my life insurance policy monthly. I can still live comfortably. So you are now designed to be paying $5,000 every month from your life insurance policy. 5,000 plus the 6,000 you got, how many? 11,000. Now you come back again. You've been somebody who have worked hard. You have worked hard. You have life insurance, you have annuity, you have social security, you have some other investment you have made. For instance, you have a home. You have a home, and there's tenant there. You have a tenant, and you have paid off that home. Every month, your tenant, you are getting from your property, let's assume another 4,000 or 3,000. They pay you 3,000. Remember, you have paid off the home. That home belongs to you. You are only paying tax to the states annually. But you are getting at least 3,000 or 2,000. Let's be fair, 2,000 from that home. 2,000 added to 11,000 already get. How many is that? 13,000. So tell me, who is that person who is retired and still making 13,000 every month? Who is richer than that person? Nobody. But is this impossible? Yes. Is it not possible? Yes. It is not possible if you do not start on time to make your plan. It is very, very 100% possible if these things we are saying are initiated on time. So you can see why some people will retire, and when they are sick, they go to hospital, they still write check for their grandchildren to go and buy Christmas gift. So that's the truth. So it's very, very possible for us to put ourselves in order. But do we have all it takes to do that? The greatest thing that we have all it takes to do that. But do we have the knowledge? No. So what you are in here today is to begin to educate those who don't have the knowledge. And you that have the knowledge, try to organize your own. It's not late. You can as well do something right now. It's not late. But the mindset is what has to be changed. If the mindset is changed, you are making $500 every month. You can still twist the hand, remove a little bit out of it. It's not about how much you're making. It's about how much you have programmed your mind that look at how much that'll be going for my tomorrow. Sometimes, just like when you are writing policy, when you begin to write policy, they said you cannot, and when you're writing life insurance policy, they cannot approve you more than 20% of your annual earning. They call it 20-80 ratio. 20-80 should go to your what? Protection portfolio. 80 should go to your what? Whatever. You want to buy Louis Vuitton, it comes from 80. You want to give Dutch people money, it comes from 80. You want to pay for your home, it comes from 80. If you want to buy limousine, it comes from 80. But the 20 should go to your protection. When we talk about protection, we are talking both your health, both your retirement, that all added together is your protection, which means you are protecting against tomorrow. All right. So, I think that answers your question.
Yeah.
Everybody have known what set life annuity is. We have talked about this. So let's go ahead. This thing is just taking all our time. Annuity period certain. Annuity certain or period certain is a description of income or installments for a fixed period chosen by the owner. You know, we are on payout amortization period classification. Annuity period certain means that you have designed it. Remember, all this thing we are saying now starts from when you are buying the policy, when you're investing the money in the annuity. You are trying to, all these things are mapped out. What type of income? How is the money going to be distributed? All are determined in the time you are making the contracts. So in that time, you will now decide, so, all right, when is the accumulation period, and what will be the amortization period? And during the amortization period, what distribution model am I going to choose? Am I going to say every month, give me this amount? Am I going to say, let it become as income? Am I going to say, no, I don't want it to become as income. I want to take in a lump sum. So all those determined at the initial phase when you are writing the policy. So the annuity period starting means that you as a person have chosen choosing your payout to be a monthly income. A particular period, if you say, if you're taking it monthly, you say, all right, I want to take it first of every month. That's period certain. First of every month, that amortization, the percentage of choosing to come to you will come to you. Then based on that, it can now extend to so many the years. The years now, it becomes the period. How many years you want it? Is it 10 years? Is it 20 years? But you have a period starting, first of every month. You have to take that. That first of that every month, how long are you going to take it? That how long is the period you're going to take it? Some people will start taking their annuity when they are 70 years. Some want to start taking immediately they resign from their job. I mean, immediately they retire from
what?
Change the channel.
So
If
they retire from their job, immediately they retire from their job, some people will start taking their annuity because they have retired from their job. Some people will wait until a particular time in life when they think that they don't have any means to take care of their old age, they now begin to take their annuity. Remember, it's a retirement income. Annuity is the only platform that guarantees you a retirement benefit that you can get assessed when you retire. It's guaranteed. Remember, annuity liquidified estates and life insurance was
Creates. Creates, right?
Good. Life insurance creates estates, of course. You know why we say it's create estate? Remember, when somebody, if someone writes a policy and the person passes, the benefit go to the beneficiary. Is that true? So, in particular, that particular person have created a wide estate that will benefit both the unborn. More especially, when you have designed it the way that that benefit is not being used by those who can use it, finish it in 1 month. So the question now goes to who and who is you going to hand over the benefit? Is the person going to utilize it well? Of course, if the person do not receive the education you receive today, may equally use it the way you may not like. If the person do not use it the way you are using it, you know today, the person will not use it, will not make use of it. Of course, some people go along to create a very strong-worded trust that prevents such people from accessing it. Some people will say, have a trust fund, they said, they give condition in which even their own children can take it. Some people say their children, if you don't have a PhD, you can access my trust. Some will say, if you're not married, you can access my trust. It's condition that you can attach to your trust. So even if you are not there tomorrow, what happened? They're not going to access it. On the attender stage, you said it, they will attend. But the good thing and the most important thing is for them to assess the one they can access. While you are still breathing, you see them assess, you are convinced that, look, if you're not there tomorrow. In fact, I met somebody last 2 weeks. That was not last week, during Thanksgiving. I'm from Nigeria. The guy come from Nigeria. So he sat at the table at the Thanksgiving dinner. So he was telling us, saying he's a billionaire. I look at my neighbor, I look at this person, I look at this person. We now have been in this field as called finance. Whenever you mention money, we want to see what is going on. And that's how it will be to you. Whenever somebody mentions money, I want to know what is the source. Because you are aware of finances. Whether you have it or you don't have it, that is not the question. The question is that you know how it comes. So I asked, when he says the billionaire, the urge could not allow me to hold it. I said, no, Vessel, please. How did you become a millionaire? Because I want to be a millionaire. Everybody at the table, we're on the dining table eating during the Thanksgiving. He said, all right. He began to tell us a story about his father. How his father handed him billions of dollars transport business. And what his father used to do then when he was alive with him. Are you telling me that if that father do not instill discipline to that guy, will that billions of dollars transport company still be around today?
No.
You're not. So it brings us down to all of us here who have 1 or 2 children. Sometimes it becomes a mandatory that they should know what they don't want to know. That's the basic truth. Getting your children, let them get. You don't have to tell them to go and make millions out of this business tomorrow, no, but let them get this knowledge. If they get it, you're okay. If they get it, become aware of their surrounding, you'll be fine. Even the person join the ancestors tomorrow, you already know that you are covered. There are some parents who have fought hard. If they look back, they're no longer in this world. But if, like, say, God will come tomorrow and say, let all those people who pass come back, and they see that all their sweat is in ruins, they will cry. That's the truth. You cannot give what you don't have. That's the basic truth. You can't give what you don't have. So the annuity period starting means that you decide when you take the annuity and at what period. You decide when you begin to take it, at what age, until when you die. Some people will take it for life. I always like to do annuity for life. Yes, I did for life. But however, some people, just like the first one we see, single, where you don't have a beneficiary. Of course, might have a beneficiary.
That one is that's life.
So some people will not do the one that have. Some people will not do the one that have a beneficiary, but I did. So look at what annuity period start means. This means that the monthly income will be paid for a specific period only. Monthly income paid for a specific period only, and not for life. Payment ceases after the specified period, even if the annuitant is still alive. That is annuity period starting. You have decided that every 1st of January, pay me my money. And I'm 65 years old today, and I did annuity period starting that will take me to 75 years, or will take me to 80 years. And I'm 65 years old today. What it means that every 1st of month, pay me $200. You pay me that $200 every month, 1st of every month, you pay me $200 until when I get to 80 years. So what about if that person did not get up to 80 years, that person died in 75 years? What happened to the remaining amount? That is when beneficiary now come. Now, if for annuity period starting, a beneficiary is attached to it. So if the person passes at 75, his beneficiary will continue to collect that $200 until that remaining amount finishes. So for Saida asked that question, annuity period starting incorporates the beneficiary. So when the person passes, the beneficiary continues to get the money. So look at this graph here. Look at this graph. Annuity period starting timeline, 20 years. The person designed the period to be 20 years. That is, he will collect the money for 20 years. This man purchases annuity at when he was 80 years. He made it that accumulation will be from this 20 years to what? 70 years. Now, when we begin to receive money, he received money from 70 years to the thing, it will finish by 10 years. So he just made it. Some people will start, we like to even start from 60 years, depending, of course, nowadays the retirement time is, I think, 70 years now. So most people would like to start receiving 70 years. But this person purchased 60 years. Joe received payment age 70. It's 20 years term. That is, period starting is 20 years. So he's going to only receive what? 20 years. So from 60 years when he starts receiving, he receives what? 70 years to 80 years, which is 20 years. So this period to this period is the period of amortization. That is period in which Joe received payments. Now, if Joe passes, what happened to the remaining amount? At age 90, the payment stopped on 20. And if Joe died maybe around 70 or 75, the remaining amount should go to the beneficiary. At 90, Joe doesn't have anything to receive again. His payment stopped at 80. That is what annuity period starting timeline. I hope it's clear to everybody. All right. So that is annuity period starting. Now, life annuity without period starting. Go back to annuity period starting, which means Joe is receiving the money until when the period that money will finish. That is annuity period starting. Now, if Joe dies in between when the period starting is still intact, the beneficiary collect the remaining. That's annuity period starting. Let's now talk with life annuity without period starting, which means it is not specified. The period is not known.
Oh, so, there is without period starting.
Yes, with period starting and without period starting.
Okay.
Yeah, so this you should be able to differentiate the two. So a life annuity with a period starting pays guaranteed minimum benefit. That is the first one we treated before. Now that is income for the annuitant life or specific period, whichever is longer. This means that the contract pays a survival benefit if the annuitant dies before the end of the period starting. Sometimes 10 years, some 20 years, some 30 years. All this is boiled down to how much do you invest. In other words, the annuitant or the survivors are entitled to guarantee income for at least a specified number of years. So, for example, let's say at age 60, Joe purchases the life insurance, annuity products. He bought annuity products, period starting for 20 years. Now, Joe will continue to receive what? Annuity payment for as long as he lives. No period starting. He will continue to receive the money as far as the payouts continue to come to him as far as he's alive. And now, what of if he dies? If Joe dies, payment will stop. There is no beneficiary attached to it. So that takes us to what we see before, the single one.
Straight or whatever.
Yes. So this is the same thing. You continue to take that money. If there is no period specified, you continue to take the money on the person buy. If the person buy, what happened? The payment stops. And period starting, the payment will not stop in period starting because what? There is a beneficiary attached to it. So in this one, there is no beneficiary attached. All right.
I'm confused.
Yeah.
What is the difference between annuity without period starting and straight life?
All right. Remember, in straight life, there is no beneficiary.
There's no beneficiary,
without
yes.
period starting, there is no beneficiary.
Mm-hmm.
But the difference is this: without starting, what happened? You be paid, the money be coming to you until what the person passes. Remember,
Okay.
in straight life, you have a period whereby that money can come. The money
Okay. You receive income for life.
yeah. So this one is income for life. You're going to receive it until the person passes. When the person passes, the periods, the payments stop because there's no beneficiary attached to it. Whether you complete the payment is completed or not, yes, it ends. It ends. Whether there is still big money there, what happened? The insurance companies, their gain is in the contract. They're not taking it to your estates because it's not your money. It's a contract you signed. However, for some people who have much fund, some people can decide to do a particular one just for themselves. All those are luxury. After all, some people buy aircraft only for themselves. So some people can still decide after all the things they have done for their beneficiary, they decide to do one for themselves.
Sorry, sir.
Mm-hmm.
Under this settlement option, there's one we treated yesterday that you made mention of life income for life or life income, something like that.
Oh no! All right, we are talking about when it's joint, single only one, or joint or with survival means that two people. Where we say if one person can have it, two person, when one person dies, the next person
we take over.
We take over. There's another one that when one person died, the next person will not take until the next person died, the beneficiary will take over. Remember?
Okay.
All right. So we're still gonna see it in life insurance, but it's an annuity. We're still gonna see
this annuity is you get a CB.
Yeah, this thing is so much.
I'm telling you.
No, this is a very big topic. But the good thing is that if we finish it now, we go back to chapter 4. We've come to chapter 8 again. To chapter 9, we still do it again. So with all this, there's nothing will make you not get it through. It's not confusing. Just get the classification. If you get the classification, believe me, what we are doing now is expansion of what we see on the classification. That is basically what it is. So life with refund option. With a life with refund option, the contract owner makes premium payment to the insurer throughout their life. Still, the contract also assures the return of the original amount paid into the annuity contract. That's the principal if the annuitant dies before the principal is distributed. This one is very straightforward. Is what we call, who can relate it to term life insurance? Can someone relate it to term life insurance?
That pays only.
Right. Can you relate?
I do not understand it, sir.
Can you relate it to return of premium rider?
I do not understand it.
All right. Let me repeat this one. It's a life with refund option. You will pay the person will be paying the premium, and if along the line, when you're paying the premium, it's called what? Accumulation phase.
Accumulation period.
So you are during the accumulation phase, you are paying the premium, and along the line, the person passes. If the person passes, all the premium paid will return back to the beneficiaries. Is that clear?
Yes.
That is exactly what it is. If the person, during the accumulation phase, this person is paying money to the account, now that is the accumulation phase. It has not reached the amortization phase. Remember, amortization phase begins after accumulation phase. Now, this man is still on accumulation phase. So he passes during that time. What happened to the money he has paid in? The money will be paid back to the beneficiary. That is life with refund option. Now, my question is this. Can you relate it to term life insurance with return of premium rider?
Mm-hmm.
So, because basically what it is a return of premium rider. The
I
return
thought
of
return of premium rider, isn't it like when you cancel, right?
no, it's not only cancel.
If you cancel, then the insurance will give you whatever after they take.
No. When you are no longer paying, if the person passes, if the person passes, as far as the term has not reached, if you have a return on premium rider in your term life insurance,
Oh,
the
okay,
premium
you have
paid,
to have the rider on.
you have to have the rider.
Yes.
Remember what I said about the
Yes.
riders yesterday? So you have to have a rider.
Okay.
If anything that can cause you not to continue to pay happens, the riders, the money, premium will return back to you. So in annuity, they call it life with a refund option. So return on premium rider is just as life with refund option is just like return on premium rider. So in case if you see it in the exam, immediately you see life with refund option, take your mind to return on premium rider. That's exactly what it is. Return of premium rider give you the flexibility to get back your money if you cannot be able to pay or if you terminate or if you cannot be able to renew. However, are you going to get all your money back from A to Z?
No.
Because what?
There will
There
be
will be
some
charges.
deductions, the administrative and other charges.
Yeah, all those charges will be reduced from that premium. So whatever remains, what they will give you. But however, it is not better to get some than to not get nothing. We were talking with one lady, was last week or what? So she have term, she didn't have return on premium rider, and she canceled. Of course, as an agent, please do not allow anybody, do not tell anyone to cancel this policy. It's not a good advice. Don't do that. So, but the lady, upon the education she feels she received, she feels that if she continues to pay that, it does not make anything to her. So she now decided to cancel. Now we asked her, did they give you back? Did they give you back your money? He said, they didn't give her a lot.
Oh.
They didn't give her a lot. So if she said that, I begin to laugh. Not only say, why are you laughing? I said, I'm not laughing. I'm not laughing. So it's me that I asked the lady, why don't they give me back her money? He said, I don't know.
Oh.
I wouldn't blame her. Honestly, and that is the honest answer. She doesn't know why the money was, at least she didn't get it. Because believe me, she would have been the happiest person if at least 1,000 was returned to her. She'd be so happy. Because it's not like money you forgot, money thrown away. Now you have seen $1,000 back from me. You'll be so happy. But does it come that way? No. You have to make sure that during the contract stage, you put it there. I now asked her the question, do you have a return on premium rider on the term policy? He said, what is return on premium rider?
Oh.
Oh my God. That's all right. Anyway, the good thing is that you have started getting the knowledge. You know what it is, and you know that you need it when you are writing policy, particularly term life policy. You need it. So in annuity, just say something. Return on premium rider is life with prior refund option. You have it in your annuity. The inoculation phase, the person is not there. Then what happened? The beneficiary get the refund. This one is not a rider. It's there in your annuity. Return of life with refund option is not a rider, please.
In annuity?
Yes, it's not a rider. It's inbuilt.
Is it in all annuity?
Of course, it's inbuilt. Yeah. So let's look at this exam tip. It says, remember, an annuity starting guaranteed payment for a specified period. A refund annuity guaranteed the entire principal will be paid either to the annuitant or to the beneficiary. So please, it's not Remember, this is an investment, more especially when you are taking the risk. Remember, in annuity, you bear the risk. You bear the risk. Your money is your money. It's quite very, very important even to bring it your money. You keep it in the bank that you think the opportunity for you, put it in annuity. It's not lost. It's there. But the good thing is that you have locked it in to participate in what? In the gain and not in the loss. And more especially, indexed it to be able to emit much, much profit or interest out of it. You can see the difference between when we are speaking about life insurance, when we're talking about annuity. Life insurance is never an investment. But you can see we refer most often to annuity as investment portfolio. Can anybody differentiate the two? You can see that when we are talking about annuity, we are more certain, more pronounced on what impact it makes in the life of people who have retired. Because this is your money you bring to put somewhere. It's your own sweat. You bring that money to put somewhere. But in life insurance, the benefit is a promise, which is conditional upon that loss occurring. And what is that loss occurring? Is that person passing. But more especially, is the riders attached to life insurance, which beautifies it, which makes it more interesting. Well, what are those riders? The riders that we say the benefit while we are still alive. You can see the difference.
Yes.
The benefit while we are still alive than this, compared to this one that you have done, you know, is you. We don't talk of investment in life insurance. It's never an investment. But come to annuity, you see that you bring your money to keep somewhere in a place you want it to be, that you are sure and guaranteed that the principal is there. But in life insurance, do you have any principal? No, you do not. It's a promise. Promise. The death benefit is a condition, it's a promise. And in the contract, in life insurance contract, that is what the insurance company brings to the table. That promise they have made you that they're going to pay the benefit. The benefit only comes when there is a loss. The benefit will be triggered by the loss. Is that money your money? No. But whatever, because you have entered into contract with life insurance, that benefit will come to you. It becomes guaranteed that that benefit will come to you. Now, just like I use the pizza, just like pizza, you want to beautify the life insurance. You won't put all the riders. You put all the riders, what happened? All the riders are there. You now have an opportunity to enjoy it while you are still alive by adding those riders to give you benefit while you are still alive. All right. So, any confusion? Any confusion? So, classification according to number of lives.
Oh my God.
So, it's like everybody's tired.
So much.
Everybody's tired. Of course, we almost end. We are ending.
Oh, like you go on, let's finish this thing today before we come back tomorrow. Yeah. Let's finish it today.
Oh, God. So, the classification according to the number of lives. Somebody asks, what of the single life annuity and joint life annuity? We have in life insurance, we have single life and where one person is insured. If that person is insured, we have now joint life where two people are insured. If the first person died, what happened? The second person will get the benefit, which is a single. The joint means that if two of them dies, one person died, no benefits to the second person. Until the second person died, the benefit will go to the beneficiary. So that's why we see what we call joint with survivorship. That is in life insurance. I'm not talking about in annuity now. I'm just talking, what I'm saying is about life insurance. So in life insurance, you have joint life, then you have what we call joint and survival. So I want you to know today, anytime you see survival, it means they are talking about joint with survivor, because what it means is this: two people are the contract owner, or two people are the annuitants. Remember, annuitants is quite different from contract owner. I hope everybody still remember. But however, the contract owner can be the annuitant. The annuitant is that person who will collect the benefit when the contract owner passes. However, whether the contract owner passes or not, the beneficiary will be the person who collects when the contract owner passes. The annuitant is that person who will collect the benefits during the annuitization period.
Mm-hmm.
What is the meaning is that the contract owner can equally be the annuitant. But however, the contract owner can decide to assign any other person as an annuitant, including himself. Annuitant can be 2 people, 3 people, 4 people, 5 people, 6 people, even 100 people as you like. Such as beneficiaries can be as number as you like. You can bring all your community members to be your beneficiary. Yes. Is it allowed? Of course. It's allowed. You can bring as many as you want to be your beneficiary. So as the annuitant, you can bring as many as you want to be your annuitant. But the contract owner remains that person who have the contract. Can the contract owner be the annuitant? Of course, yes. Now, when you talk about joints, it means that the annuitant are two. The contract owners is the annuitant. For instance, husband and wife become the contract owners, and they're the annuitant. If one of them dies, the second person cannot get the benefits until the second person dies, which means whenever it comes like that, it's talking about survivorship, which is the beneficiary. Who benefiting is the beneficiary. Even in life insurance, if you have a joint life insurance, 2 people have the policy. If one person dies, the second person will not collect the benefit until the second person died. The benefits go to the beneficiary. That's joint. The other one single. When one person died, the second person will collect. So we're gonna see it. I think it's in life. I think we should do quick and get out from this annuity, so we can see other chapters. Individual and single life annuity. The individual or single life annuity is the most common annuity. Of course, everybody want to do it. It's most common, which means one person have it. You are the contract owner. You can have several annuitants you want, and can only have a beneficiary. The annuitant becomes that person who collects the benefit. Then the beneficiary becomes that person who collects the benefit when the contract owner dies. All right. It is a pure life annuity covering one life with no survivorship. That's what individual or single life. There is no survivorship attached to it. One started it to provide a recipient with income for life with no refund paid to anyone upon their death. Of course, with single life, we talked about it before. Now, joint life annuity. A joint life annuity is type of multiple life contract that pays benefit to 2 or more annuitants. It's just like life insurance, what happened in life insurance. However, all benefits will end upon the first annuitant death. In this manner, it's like joint life insurance. Joint life, one person dies, everything goes. Now, joint life and survivor annuity. If one person dies, the benefit will not be paid until the second person dies. The benefit will not pay to the beneficiary. So these are how you're going to differentiate them.
Engineer Bag.
Go ahead.
This joint life annuity, that means the time of annuitization, the 2 people should be taking their money at the same time.
Of course, yes. 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 All right, so let's go ahead. Surrender charges, we're going to see it on life insurance. I don't want to go. Let's just jump and get out from here. Non-forfeiture values, we're going to talk about in life insurance. I think in chapter 5 or what. Guarantee minimum withdrawal benefits. A guarantee minimum withdrawal benefit is a rider. All right. Look at the rider we see now in annuity. You can put a guarantee minimum withdrawal.
So, sorry to take you back. The joint and survivorship, what did you explain? What did you say about it?
Which one?
Joint and survivorship.
I think I will say it's just the same thing with life insurance. Let's go ahead. Let's not go back on it. I don't want us to continue to dance. We should get out from this annuity. I'll tell you the truth.
Annuity.
Just like somebody said. You see, what I want you to know now is that we have almost gone the difficult part of it, understanding them. This sort like joint life, so all those ones are just the same thing as it is in life insurance. Did you get me? In joint life, survivorship, what it means that if the first person dies, the second person is not going to collect the benefit. You're going to wait until that person died before the beneficiary will not collect the benefit. That is joint.
Okay.
When you see joint survivorship, it means that the benefit is going to the beneficiary. The annuitant cannot, we die, the benefit goes to the beneficiary. That is what you have to know. When you see joint means joint with survivor, means that the beneficiary is getting the money, not even in life insurance too. If that is a joint life insurance policy, now the first person dies, the second person will not collect the benefits. The benefit we're not going to pay if husband and wife normally do it. When they do it for their children. If the man dies, the wife is going to will not collect the benefits. Until the wife dies, the children will not collect the benefits. It's for survival. That's why they call it survival. The beneficiaries go to the benefits go to the beneficiaries. All right. A guaranteed minimum withdrawal benefit, of course, by the word withdrawal benefit, minimum withdrawal is guaranteed to how many you're going to be taking. All this is also included in their variable annuity contract. Is always remember what this. This is what a rider. Sorry, remember this, a rider. This one becomes a rider. You put it there. It is not compulsory that you will have it. But however, is it beneficial? Yes, of course. It makes your contract look more beautiful. So if you have a guaranteed minimum withdrawal benefit, how much you want to be withdrawn when the annuitization period starts, what percentage of withdrawal, how much do you want? This will be determined in the contract. So the policyholder will what? It guarantees the policyholder a steady stream of retirement income. Because he will say, I want my money every month, please give me $100 from that my money. But however, you have to put it initially when you are writing the contract. You have to specifically mention it, add it. Is it going to affect your premium? Of course, remember in annuity, nobody asks you to pay premium. The good thing about annuity is that you're not paying premium to anybody. Nobody will call you that you have not paid because of it, their contract is being terminated. But can it happen in life insurance? Of course. If you do not pay your premium, the contract is gone. So an annuity is just an investment portfolio. But can annuity do what life insurance do for you? No. Can life insurance do what annuity do for you? No. All of them have their separate way of helping you in your retirement. The life insurance is more of protecting you, everything around you. The annuity is more of making sure that you retire perfectly. You can see the difference. That's why we keep on mentioning investment when we are talking about annuity. So during market downtown, look at this. During market downtown, the annuitant can withdraw a fixed percentage of their entire annuity investment. Annual maximum withdrawal percentage vary by contract, but are generally between 5% to 10%. The initial investment until the total initial investment is depleted. During that period, withdrawal period, the annuitant may continue to receive income. So all this is, if you add it to your annuity during the annuitization period, you'll be happy. You'll be happy. So like those people who say they're eating their policy now, of course, that's what it is. Can this thing be done in life insurance? Of course. But is it an investment? No. In annuity, is it an investment? Yes. Because it's what is it keeps you in, makes you income, steady stream of retirement income. Steady stream of retirement income. That's what annuity can provide for you. But can a life insurance do that? Of course, yes. But is it an investment? No. All right. So life insurance is never an investment. Please have that in the back of your mind. But can it protect you? Of course it will. If you design it well, with some riders added to it. Guarantee minimum income benefits. It will guarantee you minimum income benefits. Guarantee a minimum income amount at the amortization period, regardless of market performance. So this becomes another thing you can add to your, another you can put in your annuity, which will guarantee you minimum income, no matter what happens in the market. You see, just like being a risk taker, I always want, when you say this thing is guaranteed. So the income you're going to get is guaranteed during the amortization period. That income is guaranteed. I don't want any story in that income I will get when I get to 70 years or 75 years. I don't want any story because I don't want to wait until my daughter or my son to come and give me money. No, I don't want that. I don't want when they come, I'll drink milk. What if you don't have the time to give you the milk? Your person will remain hungry. You will stay without drinking water. Hey, milk. So all of us, particularly those of us who are still working, prepare it now. Guaranteed minimum accumulation benefit. The guaranteed minimum accumulation benefits guarantee that the owner's premium paid into the contract will have a minimum accumulation value after a set of waiting period. The net premium are typically multiplied by a factor of 1 to 3 determine this premium. The contract does not need to be annuitized for this benefit to be triggered. So this is another rider you can put, guaranteed minimum accumulation benefit. So even while you are doing accumulation, you can still pay out, can still pay you. But can it just happen in an annuity contract? No.
No.
It's you that can trigger it to happen, which means you have to put into it. You have to ask for it. Just like that somebody will put term life insurance and ask for return of premium rider. You ask for it, it will put there and you add to your premium. So for this one, you're not paying any premium. Rather, what you are paying, you are putting money to the account, then it will be established in there that this is part of the contract. So whenever anything happens, you can still get your money. So while you are doing accumulation, you can still make some withdrawal. Somebody asked that question yesterday, can it happen? And we said no. But you can see that it can happen because if you put it as a rider in your contract, you are accumulating. Remember, we say amortization must start when accumulation ends. And we said again that during the amortization period, you must, within the first 12 months, you must at least have collected one benefit. I think that's what we said. Who still remember that?
Yes.
Yes.
30 to 12 months.
Yes. So if that is the case, you, as the contract owner, have to design the annuity in a way that the amortization period will almost tally with your retirement or when you think you can no longer make an income. So let's assume somebody who is 55 now, knowing that the retirement age now is 70 years. You put an annuity, all right, let's assume somebody who is 60 or even 65. You see that the retirement age is 70 years. That's to you, because there is no retirement except when you program yourself you want to retire.
Retire.
Even sometimes they said you retired, but you know they have not retired. You are still looking for one business or the other. In fact, that's even the time you now begin to work harder than you are working before. Because if you retire, it means that you are retiring to go and die.
Well, the strength won't be there again to work harder.
Yeah, the strength may not be there, but your brain is still working. Most often, being rich is not by strength, it's by your brain. He said, what you put on your brain is what you get when you are old. What you put on your brain is what you get when you're old. So that's basically what. So you can do a guaranteed minimum accumulation benefit, which means when you are accumulating, you can get the benefit. If you are 65 years and you are writing annuity, or let's assume if you are 70, within yourself, you are still convinced that God is with you. You may live another 35 years or 30 years. You are 70. You can do annuity of 5 years. So at 75, the transition starts on your 75 years. Or you can do annuity of 10 years. So when you are at 80, the transition period will start. So you have to check how it is. You can decide to do 20 years annuity. Remember, the more the period, the more money accumulated. Everyone should know that. Everyone should know that. So long-term care riders. We have long-term care riders in life insurance policy, which can be as a rider in your policy. It can only also be a single policy. So in annuity, we still have long-term care riders. A long-term care rider may be attached to an annuity or a life insurance policy, allowing for the payment of percentage of death benefit if an individual requires long-term care but is not terminally ill. So you see that somebody can be benefiting from his long-term care rider in the annuity. If you have it as a rider there, at a particular stage in life, you can decide to, let me start collecting my annuity. You see, if we are known all this when we are younger, when we are still 10, 20, in fact, when we started a job here in this country, like those who just came to the country now, you know it, somebody would have designed this in a way that when you retire, you do not look at anybody. You are now getting all you want. You don't look at anybody for anything at all. And the best retirement is when you are independent of anybody in terms of finance. The growth of the matter is finance. Or take our parents to nursing home, nobody to take care of her. Instead of them to say, I take our parents to nursing home because we don't have money. They say, I take our parents to nursing home because nobody to take care of her. Don't think they're lying? They're lying. Who tell you there's nobody? There's somebody. If there's money, if there's all this thing we are talking about now, if that parents have it, a caregiver can be paid to come and be with the parents. Why
That's true. That's true.
It's only when there is no money, they say, oh, she's going to nursing home. We all of us, nobody's be able to take care of her. Who told you? If the parents have all it takes, the parents be at home. In his own home, not even their children's home, his own home.
Yes.
Why a caregiver come there to take care of him or her? The children, if they like, can come there to visit them. Of course, if you look at that's most of other people, callers are doing. Their parents be in their home, the children will come in to see them. The parents will be with the caregiver. So why don't we emulate that? Do all of us think those money is coming from their children's pockets?
No.
It's coming from the retirement things that the parents have organized for their life. And if you see them, they are happy. Even in sickness, they are happy. Honestly, because they are still in their damn home. They are resting, seeing their things, even if they cannot be able to use those things, but they are seeing it until when God calls them. All right. So uses of annuity, we're not going to talk about that. Of course, we have known it. All these things are how annuity work and why they matters. We said concept accumulation phase is a growing virtual element, a growing back of coins labeled contribution over time. Accumulation is a period. Money is vested over time to build a cash reserve. That is accumulation. Retirement income, a retiree receiving monthly payment from a vault. Annuity provides what? Steady income stream during retirement. Steady income stream during retirement. Estate liquidation. Annuity, life insurance will liquidate estate. Life insurance will create estate. Annuity will liquidate estate. How does it liquidate that? A house turning into a cash, flowing into a structured payout plan. Unlike life insurance, annuity are designed to spend down estates. Comparison to life insurance life insurance create estate versus annuity liquidate estate highlights the opposite goals of the two financial tools. You see, annuity and life insurance are two
Opposite.
financial tools. They are opposite. So when it's opposite, it now boils down to you must have two of them to be able to retire good.
Comfortably.
Yes, you must have two of them. But the good thing about annuity is that you can start with $10,000, you can start with $20,000. Some of us here are working and we have one or two money cash in somewhere in the bank. You are logging in to check every day, just like the lady told me. I log in. I want to see keep my money where I can be logging in to see it. I will still laugh at her one day. You want to see your money, log in to see your money every day. Every day, log into your bank and see you have 500,000 there. What does it do for you? Nothing. Is that 500,000 there? No. You only see ink. You don't see the money. Go there and tell them that you want to take off 100,000. See what they will tell you. So let's look at qualified versus non-qualified annuity. Qualified and non-qualified. Do anybody know when we say qualified and non-qualified? Do anybody know what it means?
No.
Yes. Qualified is when tax has not been taken from it, like 401k and all that. They're underqualified.
No,
While
really?
unqualified are like the paycheck you collect every 2 weeks.
Of course. So that's what it is.
Yes.
When you talk about qualified, we are talking about those accounts that taxes on them have not been paid. They are qualified accounts, such as your 401k, 403b, TSA, all those are qualified accounts. You have not removed tax on them. Roth IRA is what? A non-qualified account because taxes has been paid on them. So that is why when you are at work, wherever you are working now, they are paying you 403b or 401k. You can go to them and ask them, can I transfer part of this money to a qualified, non-qualified account? Part of them can be shifted to a non-qualified account. I did that. So when I get out from the job, when I retired, I now roll it over. The one I just told you guys, I see 2,000. I now go find out that 2,000 have been removed. So I now do a two annuity, one for qualified account, the other one for non-qualified account. Can you see it? So the one for non-qualified account, I have paid taxes on them. The one for a qualified account, I have not paid taxes on them, which means during withdrawal, I'm going to pay tax on them, and I cannot withdraw when I have not reached the age of 59, or otherwise, I'm going to pay tax and equally pay penalty. Is that clear to everybody? So a qualified account is your 401k, 403b, TSA, all those are qualified accounts. A non-qualified account is what? Your Roth. Remember in Roth, we have traditional Roth. We're going to go through it. I'm not going to talk about it. We're going to go through it when we go to that chapter. So a contract owner, you're the contract owner, you receive a tax deferral of interest and growth earned, but there is no tax deduction or premium or yearly tax saving through a salary reduction. So annuity purchase outside of qualified pension, outside of qualified pension plan, don't receive tax favor retirement treatment of premium. Outside of what? Tax favored, outside of tax favored treatment of premium payment. After tax, before tax. After tax means that you have paid tax on it.
So something like Roth.
Roth is not qualified.
Yes.
You have paid tax on it. Roth, you know how they remove Roth from your paycheck? Is this after taxing your paycheck? 401k is removed from your paycheck when they have not taxed your paycheck.
Okay.
Then Roth is removed from your paycheck when they have taxed your paycheck. So Roth is after tax money. And that's why during withdrawal, you are not going to pay tax on the principal, but you pay tax on the interest.
But for the non-qualified, you're going to pay tax on the principal and then on the interest, right?
What do you mean? What do you mean by non? Do you understand what non-qualified is?
So non-qualified is the 401k.
No,
and-
no.
Oh, no. The qualified is 401k and 403b.
At
The
the
non,
Mhm.
right?
Yep.
The
Go
so
ahead. You go ahead.
let me make sure. So if I rolled my 401k
All right,
and
let's start. I want you to know it today, at least for today. Before you leave here, you know this. What do you understand? Which account is qualified and which one is not qualified? Start
the
from there.
qualified account is the 401k and the 403b, right?
Good. Yes.
And then the non-qualified is the Roth.
Good.
Okay.
Correct.
Yeah.
You go ahead with your question. Go ahead with what you
So
want to
what
say.
I'm saying, if I started an annuity with money from my 401k or 403b, during the time of annuitization, right? I will pay tax on the principal amount and then the interest, right?
Of course.
But for the non-qualified, the one I made with non-qualified, which is the Roth, only the interest will be taxed, right? Oh, no, because it's already taxed, right? So the interest will be taxed, right?
The interest, only the interest will be taxed, correct.
Okay.
You're right. All right, you at least you know it now.
Yeah.
So repeat it after we finish, don't repeat it again, so you enter your head correctly.
It's there now.
Yeah, so what you said is 100% correct.
Yeah,
We have two types of account, qualified and non-qualified account. The qualified account is what? The 403b and 401k. Those are qualified account. And quality TSA, all of them are qualified account. The non-qualified account is what? The Roth. Now, if you roll over your qualified account to annuity, during amortization period, the principal and the interest will be taxed. Because remember, it's a qualified account, you have not paid tax on them. So the principal and the interest will be taxed. Now, if you roll over non-qualified account, which is after tax money, you roll it over to what? Annuity. The principal will not be taxed, but the interest will be taxed. Is that clear to everybody?
Yes.
All right. So if that's clear, let's jump here. Individual uses of annuity. I don't want to do this one. Everybody should know what qualified annuity plans. Of course, that is exactly what we finished now. Qualified come from a qualified account, which is 401k. So I think there's nothing to talk about here. Tax sheltered annuity 403b. All right, why is it called tax sheltered annuity 403b? The 403b can only operate by some companies, most especially non-profit organizations or some government hospitals, churches, and all the same. So you can call it 403b or 501c plan, 501c3 plan. So if you see 403b, it's the same thing as 501c3 plan. So those plans come from companies or organizations that are non-profit organizations. They give it to their employees. So some of us who are working today find out, is their company a 403b company or 401k company? So if your company said they are 403b company, means that they are non-profit organization or they are government-related organization, or they are churches, ministries, all those uses, they give their employees 403b. Yeah, so that's what it is. Then they are called 403b or 501c.
So why are they called sheltered?
Because they are sheltered. They are called sheltered because they are what? they have a special tax code that give them favorable consideration. Remember, they are non-profit organizations. They don't make profits. A non-profit organization, does it pay tax?
No.
They don't pay tax. They are non-profit organization. They don't pay tax. So that's why you see most people springing up, say they are non-profit organization, going to Africa as non-profit organization, making a whole lot of money, and they don't pay tax on it because they are non-profit organization. Of course, you are expected to make impact to life when you are non-profit organization. That's based on that, the government don't consider you, give a special tax code that is free of tax.
So does this have any effect on, so for me, I've worked with both non-profit and profit organization. So I've also had
403B and 401k.
So I have both, yes. So is there any special thing about the investment of any money from any of them?
I understand your question. If I should understand your question correctly, the thing is this. The effect may not be directly to you. The effect will be to the company, to the organization, because remember, they are tax deductible. They don't pay tax. They are non-profit organization.
I know.
They don't pay tax on it. But you, as an employee, because it's money given to you, you are not non-profit organization. You are expected to pay tax on it.
Okay, I'm just curious.
So you pay tax as somebody who is getting his retirement from 403B. Pay tax to their principal. You pay tax to the interest. But assume that when you are receiving that 403B, whether contributory or not contributory, we may not see that one today, whether contributory or not contributory, you pay that money, you are paying that money to they're paying you that money, and part of that money, you put it into Roths, which means you are telling your organization, say, look, 50% of my money that I'm investing on my 403B, let 50% go to my Roths, and let the other 50% go to my 403B. Now, what will they do? They will now, before taxing your income, they will remove the 50% that is going to your 403B. After taxing your income, they remove the other 50% that are going to your Roths. So that if you now roll over this money, these two sets of money to your annuity, what happened? During the amortization, the one that they have paid tax on it, which is coming from the Roth, you are not going to pay tax on the principal, but you pay tax on what you have accumulated as an interest.
Okay.
But the one that you pay, that coming your 403B, which you have not at all paid tax on it, you now roll it over to the annuity, you are going to pay tax on what? The
principal and the interest.
And the tax, and the interest, sorry. So that's just the difference. That's what everybody should know. I think we should move ahead. Let's look at this example. It says, in addition to TSA, IRA, annuity are an acceptable funding mechanism for other qualified plans, including pension and 401k plans. I don't think we're going to finish. This is almost 10 o'clock. 10 o'clock, we stop. Structured settlement. What is a structured settlement? Annuity are also used to distribute funds from the settlement of lawsuits, in winning of lotteries and other contests. You see, when you are rich, I read one novel one day. They are telling me the essence of richness, why people want to be rich. There is 3 categories of things that richness prepared for you. Money, specifically. 1 is for your well-being. 2 is for problem.
Oh, for sure.
3 is to help. That is why all of us are struggling today. That's why all of us are, and that one for problem is for cases. If lawsuits come out, if you don't have money, that's when you know that it's not
You're
good.
done.
It's not good to make problem. So the funds from that ability can be used to settlement of lawsuits. Equally, you can use when you win lottery to do that too. But how many of us can win lottery? So the structured settlement is annuity can be structured to settle all those if it could come up. That is what we mean by structural settlement. I'm not going to go through all this. Let's jump up past all of the business use of annuity. What business can use the annuity, of course. You can go to annuity to take money to start your business. Individuals versus group annuities. I don't think we're gonna go through all this. This one is something you can use your brain to know. We're gonna get off this. Suitability in annuity. Of course, there's what we call suitability in annuity. Let me tell you something. I'm a realtor, and when you are going to buy that home you want to buy, the people that take care of your finances, they look on two things that determines whether you're qualified for a particular loan or not. Those things are very, very special, and they are called your income and your debts. That is what, in fact, this is we are talking. Most people say interest. No, what they call it, my
Credit score.
My credit score. Sometimes become a trash. The two things that determine your qualification and what your rating will be is your income and your debt. We call it income to debt ratio. Income to debt ratio. All of us here can calculate it and find out what is our income to debt ratio. Bring out all your debts from month to month, your student loan, your car loan, bring out your debt. If you want to go buy home today, this one is secret I'm giving everybody today. If you want to go buy home today, before you even go to people who finance your home, write out your debt one place. Write out your income one place. Put them together and check what is the ratio. Your income ratio should be more than your debt ratio. If that is more, if that is, you determine that is more, now you begin to ask yourself again, you have qualified already. Now, what they want to know now is this, whether, since your income to debt, your income is higher than the debt ratio, now let's see, if this man debt is 80,000, maybe let's say debt is $300,000, and his income is $500,000.
Oh.
This man is coming to us to buy a home of $1 million. And that home of $1 million, how much is this man going to pay monthly? This man is going to pay $10,000 monthly. Now, the income is $500,000. The debt is $200,000. If you minus two of them, what you have is what? $300,000. Now, they will check if this man is making $300,000 keep by the side every month, and his house, how much he paid to the house every month is $10,000. We give it to him. He can be able to afford that home. You'll be qualified. And you can, based on that, that you have extra $200,000 sitting down somewhere, the finance will give you any amount of home you want. Even if you want to go buy $10 million home, they will give it to you. Because they will calculate how much you have remaining after all your expenses that can remain for you to pay the mortgage. So the issue of credit, yes, does credit help? Of course, it helps. But what determines if your debt to income ratio is higher, the debt is higher than your income. If you like, get 1,000 credit score, are you going to be qualified? They may qualify you, but however, are they going to give you that amount of money you want? No, because you can't afford that. Your credit score cannot pay for you. Your credit score is telling them that you are trustable to be able to pay out the way you pay your money. As you are a very trustworthy person. So yeah, debt to income ratio is the determinant of whether you'll be qualified or not. All right. Sorry about that. So
that's okay.
I'm diverting to another place.
That's what knowledge does.
So suitability equally comes to annuity. I did it when I wrote the two I wrote last week. Yes, I did the suitability. You guys are talking about life insurance as exposing you, saying out who you are. Because the person that writes policy already knows you in and out. That is how it is, and that's how it's supposed to be. The person that will write the annuity, we know more than the person that writes your life insurance policy. Of course, there's nothing to hide. When you want to succeed, you don't fear, in fact, when you want to succeed, you remove the mindset of, I'm trying to hide this. No, you are out to succeed. People will laugh at you when you fail. But believe me, if you're on the process of success, you put shit on your body, people will be happy. As far as you succeed. But they will laugh at you when you fail. So when you are writing annuity, definitely you are as, let me use the word, sorry to use it, as naked as everything to the agent. Because what happened? The agent wants to know all your investments. The agent wants to know all your debts. The agent wants to know all your plans, even to the plan of their children, the kind of school you want to send them to, and what you want to plan, what you want to spend on that. The agent wants to know all that. That's what we call stability annuity investment plan. What happened then? It is like as in real estate. They want to bring your debt, they want to bring your income. They want to put it together. They want to see your income more than your debt. That is this, you have past stability. Because they want to see, in as much as nobody going to call you to pay premium, you want to see that money you're going to remove to go and put somewhere that will stay for 10 years or for 5 years or 20 years. They want to see that that money will not affect your living. So basically, that's what it is in annuity. That's stability. So stability test, you have to pass stability test before the annuity can pass. Annuity and taxation, we have talked about annuity and taxation, one qualified and qualified account, we have talked about that. The exclusion ratio, when you're talking about the exclusion ratio, the formula is total investment in the contract divided by the expected return. Nobody asks you about that, don't worry about that mathematics. Partial withdrawal and cash surrender. You can make a partial withdrawal in your annuity. You can make a cash surrender. All those things is just like it is working on 401k or 403b. Remember, if you're not 59 and a half, you cannot take money from your what? 403b. So if the money is coming from, you're running the money from 401 or 403b to annuity, it also applies. You cannot take it. If you now decide to go and take it, you're going to pay 10% penalty tax, plus the tax involved in it, more especially if that money is from qualified accounts, where you have not paid tax before. You're going to pay 10% penalty plus the tax you're going to pay on that amount if you are taking the money before 59 and a half years. But if you are taking after 59 and a half years, it's coming from qualified account, of course, they're not going to pay penalty, but it's still going to tax their principal and their interest. Is that clear?
Yes.
All right. So that's what we're going to do on this. Distribution at debt. Of course, we have seen several ones where you can plan towards their beneficiary, where you don't want to see any beneficiary around you, even at debt. The money goes to the insurance company. The remaining amount goes to that is distribution. Distribution is equally used on annuitization. Annuitization is distribution. When you start taking the money, it's distribution. you're going to determine on the contract phase, when you're doing the contract, how do you want your money to be annuitized? How do you want your money to be distributed? So, but you know, those are time. 1003B, contract exchange. You can, I said this yesterday, you just use it to transfer life insurance policy to another policy. You can use it to transfer your annuity from one contract to another contract. You can use only 1035. 1035 is nothing but a piece of paper. It gives you the authority to change your policy. From instance, you have a term policy you want to convert to whole life. You use 1035 to transfer it. 1035 is a form that you fill, you sign, the insurance company will sign, giving them the authority to move your policy from term to permanent. If it still exists in your contract, you can do that. So 1035, you equally use it in annuity. You can use transfer from variable to fixed, use 1035. Corporate owns annuity. In insurance, we still have corporate owned life insurance. So as we have corporate owned life insurance, you still have corporate owned annuity. Remember, in life insurance, we talked about key employee policy, and we talked about executive bonus. That is what some of our people in our community do not understand. Is a way to make sure that the company is removed from problem when it arises. If there's this in every company, there's this particular person who, if that person is not available, what will happen? The company will suffer a big loss. If that person is sick or if that person is dead, that company will shrink because that person is not available. That person is a key employee. Such person, the company should put a policy on the person.
Wow.
It's also in annuity. So let me tell you one thing. Why most of people, Trump normally will say you have to pay a fair share of the tax. If you have running a small organization today, you don't have a key employee, which means you are not doing the right thing. You are not protecting your establishment. How do you protect the establishment? By putting what we call executive bonus policy and key employee policy. Who pays for the key employee policy? The company. Who owns the company? You. And see one thing, that money you used to pay the thing is now a business expense on that company. Was he working for the company? Of course. If the key employee is dead, the company gonna use that money to make sure that what? The company is protected. If that key person retires, they're gonna use that money to train another person who will replace the key employee. And why wouldn't you get executive bonus? Yes, in every company there's an executive. Those people are protected. Executive can be you. Executive can be your husband. Executive can be who pays for the team. It's your company. Who is the company? You. It becomes what? A expense, company expense. And when you are filing tax, what's going to happen? Those company expense become an expense. It's not accounted as a profit. However, what is
so
tax?
it's a business expense.
Yes, the business expense. What is tax we are talking about? Tax is what? Your income versus your expenditure. Whatever remains is what the government will tax you on. So, yeah, for you to pay a fair share of the tax, you have to be able to make a reasonable expenditure. And that reasonable expenditure is not that you go because you want to avert tax. You do not avert tax. Paying tax is the duty that every body must do. But you must have to pay your fair share. You cannot punish the company by not having an executive or key employee policy. Because if you don't have that, what happens? If something struck, the company go into extinct. And the government will not even want your company to fold. If you want the company to exist because you are paying tax for your employee, you as an employer is paying tax. Remember that. Remember that our social security we're talking about is financed by three people. You, the employee, the employer and the self-employed. So government wants all these people to be here. And the only way you can be here is to make sure you protect unforeseen circumstances coming to the company. And what can be those unforeseen circumstances? The key employee passing.
And the executive bonus.
Get an executive bonus. They want you to have them. And that's why they keep it there. But our people do not even consider that. They keep on paying more than what they will pay.
Oh,
Do
God.
government want it? Yes. But government wants your company to last more than you want it to last, because government benefits by your taxes you are paying. But do they want, if you pay them without having excessive bonus, would they like it? Of course, they will. You're paying more tax to them. They want it. But however, they want a company that flourishes, the company that lasts, continue to last, and the government continue to benefit. Government don't want to eat today, and tomorrow they will not eat again. So if you are here, you are listening to me, you have a small company, make sure you have key employee policy and executive bonus policy. It's very, very necessary. That way, in other words, curtail the taxes that comes out of you. Because most the money you're paying to the policy becomes what? Company expense. All right. So that is a corporate owned annuity. It's not applied annuity. Go ahead.
You know, somebody that is maybe somebody that has a policy that she pays maybe $10,000 every month, every year rather. So when you're filing tax, that 10,000 will be a business expense.
No.
No. Business expense come that
Because you don't have a company.
You must have a company.
I mean, a situation whereby somebody has a company.
If you have a company, is the company paying the money?
Okay.
Is the company paying the money?
No, I'm just asking a question.
Is it? Yeah, I know you're asking a question. Then I'm just answering with the question. Is the company paying the money? Is it coming from business accounts? If it's coming from business account, then it means that company is paying the money. And who have that? Is it executive bonus, or is it an individual policy? Which means you, as executive who have company, can have executive bonus that's paid from your company account. You pay the premium from the company account. It's an executive bonus. It's allowed by the law.
Okay.
It's not illegal. So you have executive bonus. The company pays the money. And what happened to the money? I mean, when doing tax, those money paid are regarded as company expense. It comes from the company account. The government wants to see, if you say you spend money, the government wants to see where you put the money to.
Okay.
Yeah. So if you write an individual policy, you can't regard it as executive bonus. In the policy, they only indicate executive bonus. So for some people who have company, they still have individuals, still have executive bonus. In fact, it's encouraged everybody to have, if you have a small company, have executive bonus. There's some things, we are alive, so
yes.
Sometimes you're gonna say something that's right, and what I'm saying is just not right. All right. So this is a summary. We are done with annuity. Somebody said we must finish annuity this night.
We are finishing now.
So this is a chapter summary. So please, what you do, go back and do the questions, because everybody here, we still going ahead. We're gonna do the annuity as a self. When we come to that chapter, we're still gonna review it when we come to that chapter. So for the person we helped to do the annuity, we jumped to make sure she understood it. So what you're gonna do, just go back, based on what we do, go back and do the questions. Then if you have any, do the questions, chapter review question. If you have any question, you can bring it to the forum that all of us, we listen to it and see whether we can give explanation to it. So that being the case, tomorrow, I think what time we have tomorrow, is it 2 o'clock or what? I will post it.
6 o'clock.
We have only one section tomorrow. And that section we go to chapter 4. So again, what again remain? We said
dental.
Huh?
Dental.
Specifically, you are going for next week, I think.
Yeah.
All right. So
I'm going for next week too. So
all right,
I still want you to tell us about Part A, Part B, Part C,
All right,
Part D.
it's very easy. We're gonna go into it, but for now, let us run on the chapters a little bit and get them up a little bit. So
Okay.
we're gonna do chapter 4 tomorrow. Tomorrow is types of life insurance, which means that's chapter 4. So you want to know the starting, what is life insurance and what type, what is the classification? If term life insurance, what are the policies? Because you have term life insurance, you have policies under term life insurance. You have permanent life insurance as a type of insurance. You have policies under it. So we're going to know all of them tomorrow. That's chapter 4. So when we finish it, we do chapter 5. Then we can still go ahead and go touch all those things they needed before they go for the exam. All right, I think that is it for tonight. Please, who have Zoom user? I don't want to see Zoom user. If you're coming here tomorrow, don't put, if you enter Zoom user, put your name. Zoom user is not somebody's name. And I believe everybody here must have registered the exam. When you put Zoom user, it means that all of us here are not, we are human beings. So who's Zoom user, please? Zoom user.
Did you see my name there? This is Sonia.
Yeah, Sonia. I see Dr. Sonia.
Your name is there.
Yeah, Zoom user, please. That person, you have muted yourself already. We want you to speak. Zoom user.
The person should talk now.
Who is Zoom user?
Hope she's awake.
Maybe the person is at work. Who knows?
No, if the person at work is he unmuted himself, he's supposed to speak. All right, he did not talk.
All right, thank you, everyone. I see you tomorrow.
All right.
Thank you.
So the Zoom user, I think I'm going to monitor this person. I'm going to take him off, and tomorrow he will not be there. Please, Zoom user, you mute yourself already, which means this person is illegal. This person is not supposed to be here. That's why he muted himself, and you know what he's doing. So please do not come here tomorrow. I don't know who you are, but never you come here tomorrow, please. Zoom user, I don't know who you are. Tomorrow, don't come to this Zoom. I will lock you out. I will monitor you tomorrow. All right. Good night, everybody.
Good night. Thank you so much.
Yeah, bye.